short-term volatility that then can resolve itself. The concern is if we cannot have some certainty in the markets.
This markets are looking for certainty, they're looking for direction.
The U.S. markets are still the most liquid and the deepest.
Nothing is safe. Everything is a risk today.
This is not the time to get out of the market, right? You need to play this out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday as the president attempts to shift the focus from tariffs to taxes.
We're going to be taking in a tremendous amount of money, and we're going to make a lot of money, and we're going to cut taxes for the people of this country. It's possible we'll do a complete tax cut, because I think the tariffs will be enough to cut all of the income tax.
The White House looking to put the spotlight on tax cuts as the Treasury Secretary Scott Bessent plays down the recent turmoil.
I've been in the markets for 35, 40 years. Anything that happens over a 2-week, 1-month window can be either statistical noise or market noise. And we're in this for the long term.
Investors turning their attention to the data, earnings from Microsoft, Meta, Apple and Amazon, and a read on the consumer, manufacturing and the labor market. Can this economy escape the volatility unscathed?
And another way of asking the same question, which is exactly the right question, is can earnings, economic data, and a Treasury refunding announcement overwhelm the whipsaw of headlines that has to do with tariff announcements that we've been getting, which has led to this uncertainty level that people have not experienced? We have 40% of the market cap of the S&P 500 reporting earnings this week. We have the jobs report. We have the JOLTS data, as well as ISM survey. Can that be enough to give some certainty?
And we're coming off a 4-day winning streak on the S&P 500, totaling more than 7%. How credible is this rally if we don't know how credible the talks are?
Well, the Treasury Secretary said he wasn't aware, he was't sure if Xi Jinping and Donald Trump got on the phone. Marco Rubio was also on the Sunday show, Secretary of State. He said that he's not going to comment on any negotiations that might be taking place or any phone calls. So it doesn't sound like the two actually got on the phone, because if you were going to call the Chinese leader, you would think your Treasury Secretary and Secretary of State would also be privy to the call.
We've had a lot of warnings from corporate America in the past week or so, from the retailers to the White House, from the airlines to investors. Southwest, brutal in the last week. Just saying it out loud. This is a recession.
So this to me is a real question. How much, as we get 40% of the market cap of the S&P 500, do we get the ultimate check? Because these are companies that range from, yes, the Magnificent Seven, as well as a whole host of different consumer-facing companies. We get McDonald's, we get Starbucks, we get Hershey's and Mondelez. We also get the oil majors. We get a lot of different sectors of this economy. Does that have more of the check on President Trump that a lot of people have been looking for than, say, the stock market or even any volatility in the bond market?
We mentioned payrolls on Friday. The estimate on Friday, a sneak peek in our survey, 130. It's not a bad number. Still expecting a decent number on Friday. That's the hard data, 130K, the median estimate in our survey. Coming up this hour, we'll catch up with Calvasina of RBC, with stocks looking to build on a 4-day winning streak. The former senior Trump trade advisor, Kellyanne Shaw, as the White House looks to iron out trade talks, and Christian Keller of Barclays on the potential impact of tariffs on U.S. growth. We begin this hour with stocks steady ahead of a busy week of results from big tech. Calvasina of RBC writing, what we need in earnings call transcripts keeps us in the camp that recession is not a foregone conclusion and makes us concerned that any adverse impacts from tariffs may be felt a little later in the year or even next year. Laurie joins us now for more. Laurie, good morning.
Good morning.
We've had quite a rally in this equity market. I'll ask you the question I asked at the top of the programme. How credible is the rally if we're not sure how credible the talks are?
So, look, I think we all have to pull in our time horizons a little bit. So as much as we would like to do things on a 6 to 12 month view, there's just not the visibility for that right now. If you take a shorter term time horizon, I've seen enough in my data to suggest it is reasonable for the equity market to try to make a stand in here. So when we went to the April 8th lows, it was an 18.9% drawdown, very similar to the drawdown of 2018, very similar to the drawdown of 2011. So we kind of bottomed out in growth scare territory where we're not pricing in a recession or crisis, but we really did have fear that one was coming. If we look at the Michigan data, if we look at AAII net bulls, you're basically at rock bottom levels, right? So from a contrarian perspective, there's really nowhere to go but up. That being said, other indicators have more room to fall. So if we look at the rate of upward revisions, it's been about 28% to the upside. That's about as bad as you need to be in a non-crisis or non-recession type environment. But if there's another shoe to drop, that's going to 10%. I will say that my team and I sort of huddled up on Friday. We got deluged by earnings. We've been griping about how we're not getting enough information. We got what we wished for, unfortunately, and we had a lot to sift through. And as I was talking to my team, I said, what's your gut feel on how this week went? And everybody said, it really didn't sound that bad, considering the setup. And I think that's the answer. It could have been worse, and companies did let us know that they're on the case. It's going to take some time. There's a lot of intellectual honesty that came out last week.
If April ended today, consumer discretionary would be positive on the month, which is kind of shocking, right? The consumer discretionary would be positive on the month, given all the headlines we've seen. Does that make sense to you?
Well, look, I do think that consumer discretionary stocks are where there is going to be value unlocked in this market. I think tech is another place. Now, I don't think that we've necessarily, kind of gotten, to that neat and tidy bow in my work, so we're still neutral on that sector. But we have been saying over the last month or so, consumer discretionary stocks are cheaper in small caps. Small caps are cheaper generally. So if you want to bargain hunt, that's a potential place to kind of look down cap. You have to have a lot of long-term patience. But, I think that when you go into these kind of crises, on the one hand, you have to play defense, right? But I don't like a lot of defensive sectors. So I sympathize with people who are trying to look for the other side. I just caution people, things may have to go down a little bit more before they go up. Any seasoned investor knows that's how you treat these environments.
There's a tricky theory out there that a lot of people have brought forward a lot of their purchases to get ahead of tariffs. And that's what we're seeing in the data. It's more robust than otherwise would be the case because of that. Is that your experience when you dig into the earnings and you look at the line items?
Yeah, and we've at the end of, I would say, like March, early April, we stopped only just looking at S&P earnings call transcripts. We started reading across the Russell 3000 and looking at conference transcripts as well. And so we got a lot of good color on the consumer from then. And so what I'm seeing generally on consumer, again, this isn't just big cap earnings, but all the consumers are getting hit, right? Like you're not sort of seeing high end is strong, low end is weak. It's kind of like the consumer's getting hit broadly. The high end seems to be trading down. So that's one thing we're hearing. But, I was laughing last week because I read a bunch of the telecom companies, and I was laughing because we did buy an iPad for my 4-year-old because we know his is about to die, and we don't want to deal with that. And I mean, just being honest here. And so, but I was laughing because the telecom companies are all talking about how mobile devices were pulled forward. And so we were exactly part of that consensus in my household. On the other hand, you are seeing, some of the home improvement companies, right, talking about big ticket items being delayed. And so there's kind of both going on, right? People are pulling forward some purchases that they know they need to have for one reason or another, and things that might be a little bit more discretionary are being pushed out. So, how is it all going to shake out in the end? It feels kind of like a muddle through. But that pull forward of demand, I do think that's going to have consequences later on.
John just mentioned that it's more than 7% rally in the S&P over 4 trading sessions, this massive rebound. That leaves the S&P less than 3% below where it was on April 2nd. That's sort of shocking to me, given the fact that actually, even with the delay, you're talking about higher baseline tariffs of 10% plus the sectoral tariffs than even what was expected as the base case heading into this. Does that make sense to you?
It actually kind of does. And, we're still well off the highs. I was talking to a colleague over the weekend. I think we're still, he did this math, not me, but I think we're still like 10% or something below the highs. And he's like, well, we're baking in a garden variety pullback. I'm like, no, not quite, because we went down and had growth scare territory. So we're rebounding from that. But I'll tell you, Lisa, my valuation and earnings work, we redid all this right after the Rose Garden. We put a stagflationary scenario in. So we put 0.5% of GDP, mid threes on inflation. One model uses PCE, the other uses CPI. We cut margins, sort of similarly to the cuts or the deterioration in margins we saw back in 2018. And we did a few other things as well. But what we saw at the end of the day, I got to 258 on earnings. I got to a trailing PE of 20.7 times. And if you do that math, it takes you to 53.51 on the end of the year at the S&P. We always say this model is kind of a compass, not a GPS, but it's telling me that we're sort of fairly valued if we're looking at stagflation. If we have to price in recession, there's another leg lower. We're not going to do 18.9 on the downside. We're going to go down to like 4,500 on the S&P, and I'm going to have to redo all the models. But I think if you assume we kind of muddle through this year, it's kind of reasonable to be where we are right now.
Lori, if we muddle through this year, when will the tariff impacts actually hit?
So it's interesting. I've been watching this on the consumer, are just the consumer companies, the industrial companies. I think they have the best read. And it seems to me, especially on the industrial side, there's been enough demand pull forward and planning, and there's sort of stickiness in pricing. You know, it depends on which company you're reading, but generally I'm seeing a lot of people who are saying, look, we're going to be able to get through the next couple quarters. We've gotten through where we are okay. Some companies are saying more second half of 2025. Other companies are saying more 2026 impacts. It's somewhere down the line. I go back to 2018, and what I remember very, very clearly was that there was still optimism on tariffs that went through the summer. We could see this very clearly in small cap pricing and small cap positioning. It was a buy the USA trade. We're going to be resilient. That all fell apart after Labor Day when the street started having their conferences and companies came out and said, oh, no, this is going to be a problem. And you started having hints of discussion for the following year. Some companies are saying right now it's going to take them more time to really give good guidance. So we really have to, nobody should go away in August, and nobody should certainly go away in September.
Oh, come on.
And people, no, I mean, I'm sorry, I hate to but you got to do the pre-work in August to get ready for September, because we all need to be out at conferences listening to what companies are going to say.
Laurie, thanks for that. You're going to stick with us. Bonus round. Laurie Calvasina of RBC. What a start to Monday. What a start to the week. Don't have a summer. Don't take any time off. Don't take a vacation. Cancel the trip. Southwest, apparently that's already happening, according to that airline. Equity futures at the moment, just a little bit softer. No real drama here. We're down about 1/10% on the S&P. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Good morning, John. President Trump floated a new income tax cut in an effort to ease the pain Americans could feel from the tariffs. In a post on Truth Social, Trump suggested that tariffs would help him reduce income taxes for people making less than $200,000 a year. He's previously argued that tariff revenue could replace income taxes, though economists have questioned those claims. Meanwhile, Treasury Secretary Scott Bessent said trade talks with Asia are going well. He said countries including South Korea, Japan, and India are leading the way in tariff negotiations, and that some nations are prepared to make significant concessions to secure a deal. And Chinese e-commerce company Shein has raised U.S. prices of its products ahead of tariffs on small parcels. The price hikes varied by category, with beauty and health products increasing by 51% and certain kitchen towels by over 370%. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later on in the hour. Up next on the program, the president shifting the focus.
We're going to cut taxes for the people of this country. It'll take a little while before we do that. I think the tariffs will be enough to cut all of the income tax.
Up next on the program, we'll catch up with Bloomberg's Tyler Kendall down in Washington, D.C. and get you more from Laurie Calvasina of RBC. Live from New York City this morning. Good morning. Good to be back in New York City. Welcome to the program to you all. Live this Monday morning with equity futures slightly softer on the S&P, down by 0.2%. Coming off the back of a 4-day winning streak on the S&P 500, the longest since the start of the year. Lots of earnings this week on Wednesday, Meta, Microsoft, Thursday, Apple and Amazon. In the bond market, your bond setup looks like this. Bond yields on a 2-year, 10-year and 30-year, just a little bit higher, up by 2 basis points on 2s, up by 3 on 10s. Your 10-year, 426.42. Looking for some hard data, you'll get that through this week, including payrolls on Friday. 130,000 is the median estimate in our survey. Going into that, your 10-year, 426.42. Under surveillance this morning, the president shifting the focus.
We're going to be taking in a tremendous amount of money. We're going to be taking in a lot of jobs, a lot of plants and factories. They're already coming. I mean, you see it. And we're going to make a lot of money, and we're going to cut taxes for the people of this country. It'll take a little while before we do that, but we're going to be cutting taxes, and it's possible we'll do a complete tax cut, because I think the tariffs will be enough to cut all of the income tax.
So here's the latest this morning. President Trump suggesting tariffs would allow him to reduce income taxes for people making less than $200,000 a year. A CBS News poll showing approval for his handling of the economy falling to 42% this month from 51% back in early March. Joining us now to discuss Bloomberg's Tyler Kendall. Tyler, pretty aggressive effort there on the taxes.
Yeah, hey, John, good morning. Well, it's because this White House is really banking on its tax cut agenda to get more cash into consumers' pockets and quickly. Now, economists have raised questions about the feasibility of what President Trump is suggesting here, using tariffs as a revenue raiser to perhaps potentially completely offset income taxes, mostly made complicated by the fact that these tariffs actually aren't codified by Congress. But lawmakers in Congress are actually returning today to Washington to start crafting that reconciliation package that will get done these tax cuts, but they do need to find some more pay-fors if they want more tax cut priorities to be included, because they're currently working off of the Senate budget blueprint that includes about $5.3 trillion in net tax cuts, and that's likely enough to make permanent that 2017 tax cut plan, and actually could include some other tax priorities. The thing is, there's just so many of them currently on the table, including no taxes on tips, overtime pay, Social Security, not to mention President Trump floating that he would like to see the corporate tax rate cut to 15% for those companies that make their products in the U.S. The thing here, though, is that last one likely won't be prioritized because Republicans are really trying to reassure their constituents amid this tariff fallout. We talked about those polling numbers at the top there. Treasury Secretary Scott Bessent was actually asked about them over the weekend in an interview. And John, he really downplayed concerns, saying that he, too, is actually watching the data when it comes to this. He pointed to consumer spending, which we know was up last month, but came in much weaker than expected as we look ahead to later this week as we get all these other numbers coming through.
Tyler, when it comes to the tax bill, what's the timeline?
Well, Annmarie, the White House wants to see it done as soon as possible, and some allies in President Trump's circle would like to see it done by Memorial Day. That's considered to be a very ambitious goal at this point. What could potentially add some fuel to the fire here is that we are waiting for a firmer X date to come out from the Treasury Department, and that could potentially really spur lawmakers to work a little faster because we know that Congress likes a deadline. It really, though, remains to be seen if they can get this done on a more expedited effort. Many estimates put this much later into the summer, potentially early fall, to actually get it done. Because we have to keep in mind, it's not just the tax cuts that they're trying to talk about here. There's also big disagreements when it comes to the chambers on spending cuts, as Republicans really are raising these concerns about potentially what this bill could mean for Medicaid. We could get potentially some headlines later today. We do know that House Speaker Mike Johnson is meeting with President Trump at 2 p.m. Eastern, and no doubt this is going to be a big priority.
Tyler Kendall down in Washington. Tyler, thank you. This would be aggressive. It was the only thing they had to do, but it's not the only thing they've got to do. There's a pretty aggressive trade timeline as well. Just getting a headline from Japan that the chief trade negotiator will travel to the United States between Wednesday and the end of the week. So Japan's in the mix, and a whole bunch of countries are in the mix pushing for the same thing.
The Treasury Secretary over the weekend talked about 18 countries that potentially they will have this deal with. And then he did caution and say, look, deals can take months, but we need blueprint. He says it's a process in place. So he sounded very optimistic that barring China, within the 90-day reprieve, they're going to get a number of these blueprints out at the door. But he's also the individual in the administration up in Congress, and he'll be back in Congress this week, meeting with Speaker Johnson, meeting with Majority Leader Thune to try to get this tax bill as well across the finish line.
With us around the table to continue the conversation, Calvasina of RBC. Laurie, let's start on taxes. Do you consider this a removal of a potential headwind or providing a potential tailwind?
So to me, it was more of an issue for last year as opposed to an issue for this year. I think there was a big, distinction between the two candidates, that one wanted to extend the tax cuts and the other didn't. And so I viewed one of those as equity market positive and one of those as equity market negative. I don't have the same, sort of assumption about this year, right? I think we want to get this done from an equity market perspective. I think that's important. But I do think it's gotten a lot more complicated, right? I'm sort of listening here about all these things they want to do. Tariffs are in the mix. Tariffs are going to pay for it, but tariffs aren't codified into law. I'm certainly not an expert on the legislative process, but I've done this enough over the years to know that there are rules and procedures that have to be followed, and the math does kind of have to balance. So I'm really confused how they're going to get this done by the summer. Back the last time they changed taxes, I think they signed the bill in December, and so that's what I've been telling my clients to prepare for, that it's going to be a long negotiation. There's a lot of uncertainty. I think they're going to get the extensions done. I'm not so sure beyond that if we're really going to get anything that's that exciting. And it just doesn't have the same excitement factor for me this year. It's avoiding a negative as opposed to enacting a positive.
Well, when it comes to the revenue-raising tariffs, how are they going to be revenue-raising if Scott Bessent is in the middle of negotiations with all of these countries?
Right. And I think the other thing is the efficiency, measures that are being taken down by DOGE, right? My sense is that those have not come in as high as initially anticipated either. So I'm just kind of wondering where all the money for this stuff is going to come. And then we go back to the bond market, and I'm not a big person on the deficit, in terms of my own research and own focus, but I know that there are those people out there, and we hear from them a lot. And I can't imagine that kind of cutting taxes when you don't have all this security on the revenue side is going to make those folks happy.
Oh, no, especially not the House Freedom Caucus, which Mike Johnson is going to have to get on board if they want to get this across the finish line. So it sounds like this is just an extension of policy. But for your base case, if they were to add in one sweetener, what do you think it's going to be?
What I keep kind of going back to is, sort of getting reshoring back in the U.S. And I have been seeing a few companies allude to the idea of maybe doing that through tax incentives. And, to me, when I think about how you're going to get that going, the idea of sort of the carrots, right, I think is really intriguing. And so I go back to that debate initially, kind of around the election of 15% corporate tax rate for domestic production. That debate, right, seems to have kind of faded into the background. But do we get some incentives? So if you looked at Bessent's, speech in New York, I think was it last month? Time is morphing in my head. But when he made that speech to the Economic Club, he talked about expensing for factories and some, business-friendly stuff there. Does that kind of stuff come in? I think that could be really interesting from an equity market perspective if it does.
You dismiss the deficit aspect. A lot of people in the bond market wouldn't. They would actually prioritize that. And there is a sort of ultimate check on how much deficit spending this Congress can do at a time when there are some questions around, yes, people will fund the U.S. deficit, but at what price, given where yields are? How much is that a concern for you, that there is that limit on how much they can do the sweeteners based on what the response will be in bonds?
Well, I think it's, it's interesting, right? It's when the deficit conversations come up in my meetings, and I tend to talk mostly to equity PMs who have been more interested in things like Doge because of the opportunities it can give to IT companies for spending on software, right, and things like that. And so there's just a different focus, and there's just a different, sort of time horizon, frankly, where we tend to be looking more on a 6 to 12 month basis as opposed to longer term. But if you start to see problems in the bond market because of this issue, it will back up into the equity market and it'll have an impact on our valuations.
Do you have a sense at which it's the danger zone if you see Treasury yields hanging in a certain place, especially with weakening growth, where all of a sudden it's sort of a warning signal that maybe the bearish outlook is more relevant than the bullish one? So
it's tricky right now. If I look at my earnings yield gap model, you have to adjust both your assumptions on the bond side and the PE side. But if we just look on sort of the bond side, the testing that I've done in my work suggests 5% is really the problem. So we haven't made that approach yet, but when we've made that approach in the past and it sort of looked like things were breaking in that direction, that's when equity markets have really gotten some indigestion. So my guess right now is that would still be kind of the marker. I think the other thing I see on the data, and I'm not a technician, but if you were to hit 5% on the 10-year Treasury yield, we're no longer sort of bobbing around, right? We're in a structurally rising rate environment, and I think that changes a lot of modeling that's done on the street.
Can you help us prepare for this week? Full of economic data, jobs tomorrow, ADP Wednesday, claims and ISM on Thursday, payrolls on Friday. I keep reading note after note that says this market will respond more to a weaker print than a stronger one. Is that your playbook for this week?
So, I would look ahead to the NFP data, to be honest, because I didn't even put the Michigan survey on the front page of my report last week. I'm just so tired of talking about the soft data at this point. We all know what it says. We all know how everybody feels. We've just got to see when this actually reverberates in things like earnings and payroll and also, just in the GDP data. And I don't think we're going to really see, my gut is I'm not an economist, but I'm not really so concerned anymore about 1Q GDP, whatever knocks we hit. Yep. We're going to deal with. It's really about what are the knocks going forward. But I do think it may just still be a touch too early to really see any kind of impacts in hard data. That's
Seems to be the consensus going into Friday, that's for sure. And I think a lot of people are fed up with you, Mitch, as well, so you're not alone. Laurie, it's good to see you, as always. Thank you. Laurie Calvasina of RBC. Just a note for you, just briefly, just moments ago, The Atlantic publishing an interview with the President of the United States, Donald Trump.
They're talking about trade yet again, and Trump is saying there's no red line that would change his tariff policy. Quote, it always affects you a little bit, but there is no red line, no certain number. And this gets back to the question I asked him on Air Force One, which initially he said was a stupid question. And then he said, I don't want to see anything in the market go down. When I asked him, sir, is there a Trump put? Doesn't sound like there is.
Equity futures just a little softer. No drama at the moment. We're down by 0.25% on the S&P. We'll continue the trade conversation in just a moment. We'll be catching up with the former senior Trump trade advisor Kellyanne Shaw as the White House works to iron out trade deals. And the timeline is very aggressive. That conversation's up next. From New York City this morning, good morning to you all. You're watching Bloomberg TV. What a phenomenal month it's been so far. Still a few days to go, but the scores at the moment for the month of April, we're lower on the S&P by only 1.5%. Truly phenomenal, given all the volatility we've seen in between, down just 1.5% on the month so far. That can change a lot in the next few days, as you know, based on experience of the past few weeks. Equity futures down by 0.2 now on the S&P. On the Nasdaq 100, down by a similar amount. On the Russell, we're negative by 0.36. With 3 hours until the opening bell, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, Johnny. We're pretty calm on the individual stock levels. There's a few things moving around this morning. Boeing being one of them, higher by 1.7%. A few things happening with Boeing. For one, it got an upgrade from Bernstein this morning saying its growth trajectory is moving along the right way. It also got one step closer to taking over Spirit Aerosystems, the embattled parts maker, which Boeing has wanted to buy. It offloaded some of its assets to Airbus, so that helped to clear the way. Moving to the downside this morning, again, not tons of drama, but it is notable that Nvidia is weaker by more than 1%. There was a story over the weekend from the Journal saying that Huawei is getting closer to producing an AI processing chip that could rival some of Nvidia's models, some of the models which China can't import because of U.S. trade restrictions. Still early stages, testing needs to be done. But again, is that U.S. tech exceptionalism going to be brought into further question? Finally, rounding things off with Tesla, still higher yet again after seeing its best week of the year after its earnings. Those shares up by 2%. We did hear over the weekend a report that they're starting to raise prices in Canada by as much as 22%. They're also embarking on this new campaign, basically saying, come and buy your Tesla now in Canada before we see reciprocal tariffs, before there are higher tariffs for Canadians. So we'll see if that tactic works. John.
We've seen a lot of front loading of purchases across several dimensions, several industries over the past few weeks. That's for sure. Danny, thank you. On our radar this morning, our top story, President Trump saying his sweeping tariffs will help him reduce income taxes for people making less than $200,000 a year. Trump previously arguing tariff revenue could replace income tax revenue.
So they've talked about this a lot, actually. But the issue you have is how are you going to have those revenue raisers enough to offset the taxes that generate to keep the government afloat, policy afloat, when you actually don't know what the revenue is going to be if you're in the middle of all these negotiations when it comes to trade? Very complicated, but it really starts to put the tax policies and folks in Washington, D.C., something this White House really wants to move forward to. You have the Secretary, Scott Bessent, going over to Congress this week, planning to meet again with all of the leaders in Congress, try to get this forward. They want to get this done by Memorial Day. That is going to be incredibly challenging. Maybe we'll get some more information today when the president sits down with Speaker Johnson.
We've said it already a few times this morning. This is a very aggressive timeline. They've got to deal with trade. You mentioned the Treasury Secretary, Scott Bessent, also saying that trade discussions with Asian countries are, quote, moving along very well. Bessent adding that talks are ongoing with 18 important trade partners, with China part of special negotiations. Lisa, we walk away from Washington unclear on whether those talks actually took place or not.
There was a lot of discussion with the president saying that they had a discussion. You had Scott Bessent saying he had no idea whether Xi Jinping and President Trump had an actual phone call. And then the Chinese coming out and saying, we are not in talks with them in whatever kind of case. Here's the issue. The length of time it takes to get any trade deal done, even if two people are willing to come to the table, is really long. That is what everybody told us in Washington, D.C. So even though the rhetoric from finance ministers around the world was, we're working with them, we're optimistic we can get something done within that 90-day timeline, people who have ever worked in trade have told us again and again, this is not feasible. This is absolutely not realistic.
So what's China doing? China is saying there are no talks, and they're also doing this. Policymakers in Beijing vowing to provide more support for exporters impacted by tariffs, including plans to boost domestic consumption, which, once again, is something that this administration would quite like.
They do, because they want to see China rebalance and put more pressure on domestic consumers. They're doing things like assisting firms also to diversify markets. Potentially, we could see China starting to dump in different places if the U.S. consumer is not going to be the one to take on that final product. Reducing costs for domestic trade, rent, streaming fees, optimizing the exchange rate hedging tool for trade firms. They are trying to combat it internally before they potentially really go to the negotiating table. One thing I will say, Treasury Secretary over the weekend, though, did say he had communications, contact at the IMF meetings with his Chinese counterparts, but he didn't say they were about trade. He said it was about the traditional financial stability of the global economy.
How many times have we seen this now, both in Europe and China? President Trump pushing these countries, these trading blocs, to do things that are good for them.
Well, it's a great point, because a lot of people have been saying for a long time that the only way for China to get a sustainable economy is to bolster domestic consumption. And that's been a problem. Here's the key question. Is the gap going to be filled by consumer spending quickly enough to offset some of the tariff barriers at a time where China, given that it's a more autocratic government, can sort of bear through this mess, and it's a gift to them? This is what I heard from the IMF, that the Chinese are so pleased that they can blame all of their financial problems over the past 5-10 years on Donald Trump, and that's basically what's sweeping social media, and it's actually helping Xi Jinping quite a bit.
The nation's capital is going to be exceptionally busy over the next couple of months, that's for sure. If you are just joining us, welcome to the programme. Equity futures here just a touch softer. We're negative by 0.2%. Investors, as you know, are waiting signs of progress in US trade talks. The former senior Trump trade advisor, Kellyanne Shaw, writing, I do not expect to see a full-blown US-China trade deal this year. Kellyanne joins us now for more. Kellyanne, welcome to the programme. What can be achieved in the interim between now and year-end?
Good morning. Thanks for having me. Well, we're certainly in a he said, she said when it comes to U.S.-China relations. And I'll put that to the side just for a moment. I think in the short term, the administration is looking to ink potentially up to 17 deals. Now, those won't be full-blown trade deals, but they will be agreements in principle, and we'll get the details of those written by lawyers in the months to come. But that is part of the negotiation strategy with China, and that is to lay the groundwork where the U.S. has deals with a number of key trading partners going into a broader discussion with China so that they have more of a leg up. China's taking a very similar strategy in its charm offensive with a number of countries around the world. But this U.S.-China relationship is going to get worked out over years and not months.
Kellyanne, how do the Europeans fit in?
Well, a U.S.-Europe deal has eluded multiple administrations for decades now. I do think that there is a genuine effort between the administration and some European leaders to see what they can do in terms of stopping the bleeding with respect to these 20% reciprocal tariffs. But the European Union is a very advanced and entrenched regulatory system, and it's going to be very, very hard for them to pivot and to change and to concede on some of the requests that the Trump administration has. So I'm not particularly optimistic.
Kellyanne, what are those requests that the Trump administration is telling the Europeans they have to see in order to get a trade agreement?
Well, they haven't made those demands public, except for this national trade estimate, which President Trump and Jamieson Greer have held up on multiple occasions and said, here are the list of non-tariff barriers. But they are longstanding and well-known. So they are talking about the VAT tax, but some of the regulatory barriers in agriculture, in automotive, some of the EU subsidy programs, the digital services taxes that a number of EU countries maintain. There are quite a few barriers to trade that are going to make it very, very challenging, and tariffs really are just the tip of the iceberg.
When it comes to China, what needs to happen for one of them, either Beijing or Washington, to blink? Because right now, it's just a tremendous amount of noise.
Yeah, certainly. And drama is certainly a feature of U.S.-China trade negotiations. It was during Trump 1. I fully expect it to remain a part of Trump 2.0. I do think that behind the scenes, both sides are looking for a political off-ramp that saves face. These 125% and 145% tariffs are not sustainable in the short or medium or long term. So I do expect to see some sort of de-escalation in the coming weeks or potentially months. But in terms of a full-blown trade deal, I don't know that that's possible anytime soon, if at all. Now, I do think both sides will at some point sit down and try to work out some of their shared differences. But at the end of 4 years, I think the U.S. and China are going to do less trade with one another and not more.
But you're talking about an off-ramp potentially we could see before they sit down. When do you think that off-ramp would be?
Well, I was hopeful that the two sides could have found something in the first couple of weeks. But you've got, on the one hand, President Trump saying that I only want to do this at the leader level. On the other hand, you have President Xi who's saying, I'm not going to do this at the leader level, appoint someone else. And so both sides are engaged in this game of chicken, arguing that the other side has more to lose than they do. Now, back in Trump 1.0, we had the G20 and these other international forums that were happening around the same time as the trade war, which gave the two leaders a political opportunity to meet on the sidelines. We don't have that in the short term. So it is either going to be President Trump saying, okay, I'll appoint someone, or some back channeling, potentially some track 1.5 or track 2 diplomacy between CEOs going back and forth to try to work things out.
Kellyanne, you pointed out that we're about 2.5 months into President Trump's 3-month window to make trade deals with virtually every nation in the entire world. And it points to how infeasible this is. How much is this just a period of time to reset the narrative before having another extension and then another extension before there is a realistic time frame for how long it takes trade deals to be inked?
Yeah, and this is where there's a distinction between these full-blown trade deals versus these agreements in principle. And I do think that it is possible to reach agreements in principle, which is basically an outline of some of the key components of what will be in those deals in a short period of time. But if you want to have drafted text that captures these trade deals, that's going to take months and months and months of time and a ton of work by various lawyers. Now, that said, if you're still dealing with 17 or 18 countries, that's still a lot to do between now and July 9th. So I do think for countries where substantial progress has been made, the president is likely to extend that period of time, although he has not said that he will do that. And then for countries that are maybe not as far along, the president's going to feel some pressure to turn those tariffs back on so that his threat means something and to try to squeeze some countries at the end of that 90-day period. So I think we'll see a mix.
On April 2nd, there was a big question around what the ultimate goal was of this new tariff regime. Was it revenue raising? Was it penalizing national security issues or potential trade partners that hadn't been doing the right thing? Or was it fairness? Now that we've seen some of these negotiations, do we have a better sense of the overarching framework of what the goal really is?
Yeah, and I think that different tariffs have different goals. So clearly one of the North Stars of the administration is addressing this substantial $1.2 trillion trade deficit. And that, to me, is what this 10% global baseline tariff is about. But when it comes to these more advanced reciprocal tariffs, like that 46% on Vietnam, that 20% on the EU, that is about fairness and leveling the playing field and addressing some of the unfair trade practices, the unbalanced trade that the president has been talking about. National security tariffs are really those sectoral tariffs, so those on semiconductors, pharma, steel, aluminum, and autos. And then this revenue point, which the president raises, to me is more about messaging. It's about selling that domestically to the American people about why leaving tariffs in place, particularly why negotiations are ongoing, may not be the worst thing in the world, because look at the tariff revenue that's coming in. But I don't see that as one of the primary goals.
Over the weekend, the Treasury Secretary was asked about this whole strategy, putting tariffs on, pulling them back. And the Treasury Secretary said, actually, it's called strategic uncertainty and game theory. You were an individual at the negotiating table. Do you think this strategic uncertainty is damaging or actually useful?
Well, I think it depends on where you're sitting. And as a negotiator, I used to say that, and I spent 10 years as a negotiator for the U.S. government, that I had the most fun working for President Trump because my trading partner sitting on the other side really had no idea what my leader was going to do, which actually gave me a fair amount of leverage at the table to try to advance U.S. interests. Now, sitting on the other side now representing companies, that uncertainty, that lack of clarity, that will we have tariffs tomorrow, won't we, is incredibly challenging in terms of making investment decisions and supply chain decisions. But that strategic ambiguity is really aimed at other trading partners, and the message is not for the business community. And so I think that tension makes it a bit challenging, particularly for domestic stakeholders, while the president works this out.
Kelly, appreciate your time as always. Kellyanne Shaw, the former senior Trump trade advisor, framing things perfectly at the end there. What can be good for talks, in the short term at least, can be bad for the economy.
Exactly, and that's why we saw executives from Walmart have to go into the Oval Office. That strategic uncertainty is making their job incredibly challenging. But if you're a negotiator, that leverage could be very useful.
Equities right now negative 0.25% on the S&P 500, with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. President Trump is pushing back against the idea that market turmoil could lead to changes in his tariff policy. In an interview with The Atlantic, Trump said Wall Street's reaction to the trade war impacts him, quote, a little bit, but said that there's no red line or certain number that would compel him to change course. Meanwhile, tensions are escalating between the U.S. and China over the Panama Canal. China's market regulator is reviewing C.K. Hutchinson's sale of dozens of ports, including 2 in Panama, to a BlackRock-led group. China says the $22 billion deal shouldn't be implemented without its approval. And China's Huawei is reportedly preparing to test a new AI processor that it hopes can replace some products made by NVIDIA. The Wall Street Journal reporting that Huawei has approached some Chinese tech companies about testing the new chip. The report says development is still at an early stage, with firms slated to receive the first batch of samples next month. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on in the next hour. Up next on this program, a whole new world.
Our view is that global growth this year and next year are both going to be much weaker. The U.S. has been the center of the system for decades, and now the U.S. is standing up and rejecting in very fundamental ways key features of the system.
Lots of economic data coming up through the week. We'll get to that with Christian Keller of Barclays. From New York City, this is Bloomberg. Mega cap tech in focus this week. Check this out. This is your calendar for big tech. Meta and Microsoft on Wednesday. On Thursday, Amazon and Apple. The scores going into that. On the month so far, only down by 1.5% on the S&P 500 through April. But for big tech, some of these names have been in a bear market for quite a while. On the Nasdaq 100, we're down by 0.2%. On the S&P, just softer on the session by 0.25%. Under surveillance this morning, a whole new world.
Our view is that global growth this year and next year are both going to be much weaker. The U.S. has been the center of the system for decades, and now the U.S. is standing up and rejecting in very fundamental ways key features of the system. And I think the rest of the world is just kind of looking around and saying, what's next? This is a completely different world.
It's a shock to the cycle, potentially a shock to the system. Here's the latest. According to one estimate, cargo shipments from China to the US falling as much as 60% since early April. Christian Keller of Barclays writing the focus is now on negotiations and potential central bank action. We still see mild recessions in the US and Europe as a reasonable base case going forward. Christian joins us now for more. Christian, good morning. Good to see you. Help us understand the way you see the sequencing of this playing out. A lot of people are tracking the ports, looking at the shipments coming from China to the US and watching that nosedive. What happens next in your mind?
Well, there's a lot going on right now. I mean, the shippings are coming down, the inventory is being built, there's been a lot of front running, so it's very difficult to sequence this. Someone in Washington told me there's no longer uncertainty, it's not what we don't know, but unpredictability of how things behave, how things react. This is nothing we can look at for the last 40 years and say, well, this is a sequence. But it would seem to us that, you're going into the second half, and then things should be visible. I mean, probably the price increases come first, starting already April, May, and then the activity, the slowdown will come a bit later. Like labor market data we're going to get this week. It's probably going to still look quite robust, but we expect that then to come off in the second half with a few months lag.
We've seen lots of comparisons to the pandemic, negative supply shock. Biggest difference is we shoved a demand-side stimulus package like we've never seen before into a negative supply shock. How different is this moment on the demand side?
On the demand side, this time, obviously, we have, if anything, the fiscal, we don't know yet what will happen, but the fiscal should be actually rather, the demand from the fiscal should be coming down, right? So we don't have the kind of positive demand stimulus, if you want. And at the same time, we have a supply shock that's a bit different from the pandemic. Yes, it's a negative supply shock, but it's, with the pandemic, it was you shut down, but you hope that somehow it opens. This time, it's a systemic shift. And I think this is the big issue here for corporates. Even if within the 90 days we get some letter of intent or some idea of principal agreements where it wants to move, this still doesn't mean as a corporate where things will be and how much you should really rearrange your supply chains globally. And I think that uncertainty stay with us, and that will probably continue to weigh on growth.
What's interesting to me, we were speaking with Lori Calvasina of RBC earlier this morning, and she said, tariffs look like they're going to be higher than we expected, but companies can still deal with that. If you look at the bottoms-up type of analysis, it looks like companies are in an okay position. What are you seeing that's different that points to recessionary conditions that really does undermine some of the rosier scenarios that are getting priced in?
Well, I would say one thing. You say, tariffs are higher, but companies can deal with this. I think the consensus in a way that seemed to shape up in D.C. last week was we end up something with, 10% universal tariff from anyone, and then maybe 50 to 60 on China, and then sectoral tariffs of 20-25%. That is still tenfold or so from what we had for the last 50, 60 years. So, to say that this has been dialed back now from the extreme, but what we end up, if we end up with what seems to be the consensus now, is still very high tariffs. And I think that would, and that is desired, right? I think the U.S. administration does want, to decoupling from China and to move supply chains out. So I think, I would not underestimate those tariffs.
Well, that baseline is what the president spoke about consistently on the campaign trail. If we were to see that, how do you view the economy shaping up? Those baseline tariffs, is that potentially meaning a recession, or can we muddle through?
We have a recession. We think the second half, it is very likely because, let's step back. We already thought the U.S. economy would be slowing. Most people thought it would be slowing this year, right? And now you have on top of this, this incredible uncertainty, which, probably holds back investment. And at the same time, we think going to affect the consumer as well. Then you can see it in the surveys. There's a lot of, questions by consumers where this will go. I think, lower energy prices help at the moment. We have a mild recession. I think this is a good chance. Balance sheets are quite healthy. There shouldn't be like the kind of deeper financial recessions that you've seen before. But we think a recession is quite likely.
Unemployment at 4.2%. The Federal Reserve has showed little desire preemptively easing into this shock. What would it take? 4.5, something closer to 5? How do you think about that?
That's a good question. Where is that NIRU? Where's that rate where they get nervous? Often, though, it's not necessarily just the level. I think, yes, going over 4.5, I think, would make them nervous. But it's also, once you hit the first negative non-farm payroll prints, I think that always has an impact. But otherwise, I think the big difference to what we had during the pandemic in the last really decade or so is that this time we have inflation expectations really having risen substantially. And the market isn't there yet. It's mostly in household surveys. But that is something I think that's very crucial. If you're on a central bank that has inflation target, that's something you can't ignore.
How do you reconcile the difference between what you're seeing in survey-based expectations and market-based expectations at the moment?
Yeah, it's a very good one. First of all, the market expectations in the short run also see the inflation increase. What's very interesting is that break-evens over 10 years don't see it. And that means that, there's still a belief that over the 10-year time span, there'll be recession and the Fed will, do the right thing and we'll end up with a broadly 2% average. That's very interesting. And that anchor of break-evens remaining there, I think is quite important. If they move, that will be very alarming for the Fed.
The Fed doesn't have to use the T word. The market's doing it for them. Is that your takeaway?
Yeah, although they kind of are using the T word as well. So there is that as well. Going forward, I just wonder how much the Fed has that luxury, even as the ECB continues to cut. And I think that that's really interesting. It's a growth differential that is not favorable to the U.S., but it's also an inflation differential that is not favorable to the U.S., which puts the Fed really in a bind.
Christian, it's good to see you, sir. Thanks for dropping by. Christian Keller there of Barclays. An important conversation about the economic data still to come this week. The overwhelming consensus is it's too early to expect to see this in the labour market. We'll check to see if we see it in the labour market when we get payrolls on Friday. The estimate in our survey at the moment is about 130k. Up next on the programme, Yoder of JPMorgan, Henrietta Treyz of Veda Partners, Mark McCormick of TD on a big election taking place in Canada, and Amanda Lynam of BlackRock on this fixed income, this debt market. From New York City, the second hour of Bloomberg Surveillance. Up next.
People are equally as nervous of American tariffs as they are of Chinese excess capacity.
Ultimately, Xi Jinping's got to make some serious decisions about how they rebalance that economy.
I don't think China tariffs are going to be resolved in the next year.
The U.S. is trying in many instances to force countries into choosing. These countries are desperate to avoid being forced to choose.
But you'd like to see a couple of deals done, right, to show that he's willing to come to the table and make a deal.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this in the equity market. Equity futures negative by 1/3 on the S&P, following a 4-day winning streak. Over those 4 days on the S&P 500, higher by more than 7%. That rally taking the scores to April to just negative 1.5% for the month, which is unbelievable. Think about all the volatility, the pain, the stress, the Sundays you were working, and we're down just 1.5% for the month of April. In the bond market, some comfort. Yields down for a couple of weeks now. In the bond market this morning, yields up by just 3 or 4 basis points. The 10-year 427.39. This week, and a price action of this week will be dictated by this screen right here. The economic data through the week, including payrolls on Friday, and Lisa, absolutely stacked with earnings from some of the biggest companies on the planet.
Yeah, we've got Microsoft, we have Meta, we have Apple, we have Amazon, we also have GM, we have Mercedes, we also have a whole host of different consumer-facing companies, whether it's Starbucks, whether it's McDonald's. 40% of the S&P 500 market capitalization will be reporting this week. Will that be enough to give us some sense that we are not in a dark room, blindfolded, bumping into walls with chairs in between us? Or is this going to simply be, okay, well, we have no visibility and they have no visibility, so we'll wait for the next shoe to drop?
They certainly don't have any visibility at all. The fate of this market, the fate of this economy at the moment, in the hands of one man, the President of the United States.
And it's called strategic uncertainty in game theory, according to Scott Bessent. And he was pushed on what actually is the strategy. So you have to think the market only down for the month, some 1%. What are they really rallying on? A phantom, as you've called it before, Jonathan, phone call? President Trump keeps talking about that Xi Jinping has called him. The Treasury Secretary says basically don't want to touch that. Not really sure if that's accurate. And then you had Marco Rubio saying, I'm not going to comment on that. What actually is the framework for any potential deal between China and the U.S.? And that is the most important deal. Forget these 18. I know they think they're important, but that's the most important deal because it's two biggest economies.
How credible is the rally? We've asked this a few times. If we don't know how credible the talks are, it's a big question for this week. Big question for us trying to follow the economy. The sequencing of things. We're looking in the obvious places. Clearly, trade between China and the United States is nosediving. You can see that almost everywhere. What happens next? Prices climb, demand falls off. The sequencing of this is going to be interesting in the weeks and months to come.
We had a lot of Fed speak last week. This week is a quiet period, so if we don't get any Fed speak, that's why. And a lot of them seems to suggest that sequencing would lead to maybe a short-term price bump, and you would get some inflation, but longer term that it would be a disinflationary type of trend. Max Kettner of HSBC put out a note this morning, which the headline was, Why Washing Machines Matter. And he talked about how the washing machine experience of 2018 gave a sense of how much demand declined in the face of some tariffs and how people rearranged some of their spending patterns, and why that is making him prefer Europe to the U.S., both in fixed income and also when it comes to equities.
Equity futures right now, negative 1/3% on the S&P 500. No real drama. This is a snooze compared to what we've seen over the past few weeks, that's for sure. Coming up this hour, we'll catch up with Yoder of JPMorgan as investors prepare for a busy week of earnings. Mark McCormick of TD Securities on the fallout from Canada's election, and Amanda Lynam of BlackRock on a temporary reprieve for bonds. We begin this hour with stocks marginally lower following 4 days of very big gains. Yoder of JPMorgan writing, we view the upcoming earnings season as important for the market as we work through downward revisions. We have widened our base case range to 5,700 to 6,200 to reflect increased volatility and uncertainty. Abby joins us now for more. Good morning, Abby.
Good morning.
There's plenty of uncertainty, let's put it that way, and companies are using different approaches to offer clarity and visibility to investors. Southwest was upfront, brutal, direct. We're in recession. What are you hearing elsewhere?
Well, so I actually think you all were talking about last week and how strong the performance was, and obviously there was a lot going on from a macro perspective in the discussions around trade. But actually, we were getting pretty good earnings results, and particularly as it relates to the AI power demand side, I would say that was like an area of particular strength. And I think in terms of the way that companies are approaching their guidance, look, this is obviously a very difficult environment for them, but we thought it was going to be a lot like 2020, where they kind of just no guidance, we don't know what's going to happen, so we're just going to pull this. And that's not really what's happening. You're getting them trying to work through these different scenarios. Sometimes you're getting two different scenarios, maybe you're getting a muddle through. And it's been really interesting to hear which companies, and in our view, become more de-risked. If let's say they extrapolate April 2nd tariff rates throughout the year, that to us is an attractive entry point for whatever company that may be. But you're not really getting these massive guide downs in terms of the full year outlook. And to us, that's, a lot of that is really driven by the AI power demand story that happened last week. But overall, it's just been better than expected in terms of earnings.
Some of the earnings themselves have been pretty decent, to your point. But I'm finding it difficult to draw a distinction between good underlying demand and just a rebuild of inventories worried about supply not being there.
Yeah, I mean, I think that's a really difficult line to thread in terms of what really is real demand. But I think for the most part, right, if we're thinking about the banks who reported earlier on, overall, the overall spend outlook, you didn't see a massive bump in terms of, it was mid-single digit spend in terms of a consumer outlook. That's pretty in line with what we've seen over the past couple of months. And importantly, looking forward, you didn't see really massive reserve builds in terms of the banks either. So their outlook doesn't feel like it's that uncertain as it relates to the consumer at the moment.
I'm feeling a massive disconnect right now. We just spoke with Christian Keller of Barclays talking about how recession in the U.S. is his base case. We were talking with Laura Calvasina of RBC, who said if recession actually does transpire in the U.S., you're talking about 4,200 to 4,500 for the baseline S&P 500. You're talking about gains from here. 5,700 is your low in terms of this range at a time where we're currently at 5,525. Why is there such a disconnect between economists and stock analysts?
Well, because look, I think, and taking a step back and thinking about where we came into the year, we're coming off of a really strong base. I think comparing this to the 2018 period is a little bit difficult because it was a completely different economic backdrop, right? We're coming into the year and we're in a pretty solid footing from both a consumer and a corporate standpoint. And so you do, there is a position of strength that we're coming from that we can take somewhat of a hit. Obviously, time is ticking in terms of how long this uncertainty persists. And, the president heard this from some companies last week when he met with them saying, look, this is a matter of weeks in terms of empty shelves, and that is very important, right? The longer this goes on, the more uncertain and the uncertainty pervades, the less likely, the upside becomes a reality.
How many companies are actually gaming out that anything even close to the tariffs as announced on Liberation Day are going to stick? In other words, how many of the analysts, how much of the ranges and the outlooks that companies are coming up with are basically expecting to go back to something like that 10% baseline, as well as some sectoral tariffs?
Well, so I would say the amount of companies that are going back to April 2nd is kind of few and far between. And again, those are kind of gems to us in terms of the opportunity set. But what you are getting is you're getting some idea of what it's going to cost from a tariff perspective from companies. And this is across the board. Pharma companies, we've heard from a lot of healthcare companies, and we haven't even had those sectoral tariffs announced. And they're trying to figure out how much they're going to have to spend. And so we're assuming it's based on the current environment, right? Without having to really extrapolate. And so there is a cost structure around it, and there's obviously a revenue headwind that they're trying to take into account. So wrapping their heads around how they're getting there is important for us to help us think through the year ahead. But I wouldn't say there was a ton of companies that took April 2nd and extrapolated, but they're at least incorporating, I think, that 10% universal.
When you think of the potential upside to your figures, what would it take? Is it policy? Is it the Fed?
Yeah, it's policy. I mean, I think the Fed, if you, for a couple weeks ago and you got asked what would be the bull, what would cause the bull case, I think it would have included the Fed and it would have included some policy pivot from the administration. I think a Fed pivot at this point wouldn't necessarily be short-term positive, right? Because it would be because the Fed saw weakness. So I think really the only bullish outcome is that you see this pivot from the administration, and the market obviously seems to be sniffing that out in terms of what we're seeing from a PE perspective. We're at close to 20 times again. And again, only down 2% since Liberation Day. So there is an element of that, but I do think that's where the bull case is now.
They're talking a lot about these 18 deals they can get with other trading partners, but when you're talking about a bullish case, you're really talking about one, right? It's China. What do you need to see?
Well, I mean, I think in terms of what the market's probably thinking, it's closer to 30 to 50% in terms of the effective tariff rate there. I think that would bring down the overall tariff rate, effective tariff rate for the U.S., something between 10 to 15%, which is digestible and something that, if we think about, again, going back into expectations for the beginning of the year, that's probably where it would have been, right? 10 to 15, maybe worst case scenario, still a massive increase in terms of where we were prior, but I think at least more digestible than the 25 to 30% that we had on Liberation Day.
This week is going to be chock full of things other other than tariff talk, which is going to be exciting for people looking to sink their teeth into something that's more concrete with numbers and that reflect things that have already happened. I wonder how you look at some of the economic data that we're going to be getting. A labor market report that a lot of people preemptively are dismissing as backward-looking and not really important. JOLTS data, ISM manufacturing. How much does it matter to you based on what you just said, which is we are coming from a very different place economically than we were in 2018?
Well, I think it's important, but I think it's also juxtaposed to what's happening in terms, like, we're going to be focused mostly on earnings. Like you said, we have 40% of market cap reporting and some of the biggest names. And I think that's going to be, like, what has been the story for the S&P 500 over the past couple of years is this AI story, which nobody seems to be talking about anymore. So you're getting these, like, very, high growth, high quality companies at a discount at the moment, obviously, aside from what we saw last week, but still trading at a discount. And so that's really where our focus is, right? Because part of our bullish thesis is that you continue to see that spend, and that's pervasive through the rest of the market in terms of AI capex. So we're going to get a lot of information there, and I think that's what we're going to be focused on from an equity market standpoint this week, is aside from macro.
The thing that conflicts with that, as you know, is that they are secular growth, but they're also facing an international backdrop which is increasingly fragmented. I'm thinking more like Apple, directly Apple. I'm just going to bring up the name directly. They're facing a big situation in China. They're going to have to spend a lot of money moving supply out of China into places like India. For those kind of companies, how difficult is this moment for them?
Well, look, I think this isn't the first time they've seen this. These tensions have been going on in terms of trade as it relates to particular industries like semiconductors since 2018. It was continued throughout, the past couple of years under the Biden administration as well. So this isn't new news, and obviously a lot of that rerouting had already taken place post 2018. So look, it's not easy. It's still difficult, but they have, their global supply chains. They at least have negotiating power as it relates to, other countries and suppliers. So they at least are coming from a position of strength in that standpoint when I'm talking about these large diversified companies. And so I think it's not easy, but if anyone's going to be able to navigate it, I would think it would be these larger companies.
That one's a must-watch. Apple reporting on Thursday. Abby, good to see you. As always, thanks for being here. Abby Yoder there of JPMorgan. If you are just joining us, welcome. Equity futures down by a little more than 0.25%. Not a big move on the S&P 500. With an update on stories elsewhere, with your Bloomberg Brief, here's Yahara Hecker. Say, Yahara.
Hi, John. Cargo shipments from China to the U.S. have plummeted by as much as 60% since the U.S. raised tariffs on Chinese goods to 145% earlier this month. Still, by mid-May, thousands of companies will need to replenish inventories. Both Walmart and Target told Trump last week that shoppers are likely to see empty shelves and higher prices. Elon Musk's XAI Holdings is in discussions to raise $20 billion. Sources telling Bloomberg the deal would value the company at over $120 billion and could be used to pay down debt from Musk's conversion of Twitter into a private company. If completed, the deal would be the second largest startup funding round of all time, according to PitchBook. And DoorDash is offering to buy UK-based Deliveroo for $3.6 billion. A filing with the London Stock Exchange shows DoorDash proposing a cash offer for Deliveroo shares at $2.40 apiece. DoorDash owns 2/3 of the restaurant delivery market here in the U.S., and a deal would help it expand into the UK and cities in Europe. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, easing the tariff sting.
We're going to cut taxes for the people of this country. It'll take a little while before we do that. I think the tariffs will be enough to cut all of the income tax.
Up next on the program, Henrietta Treyz of Veda Partners. Just how aggressive is this timeline for tax cuts in Washington? From New York City this morning, good morning. Just to get you up to speed on a developing story at the moment, Spain, Portugal hit by a major blackout. A power cut to phone lines at around midday today. In those two countries, we are seeing public transport, traffic lights, phone services mostly down across Madrid, Barcelona and Lisbon due to that outage. Train services mostly halted. The latest from the team here at Bloomberg at the moment. No reason for that at the moment. Just an update for you that we are seeing a power cut, power blackouts across Portugal and Spain. We'll have more on that when we have more for you. The latest elsewhere, the price action looks like this. Equity futures on the S&P negative by 0.3%. On the Nasdaq 100 down by 0.3 also. On the Russell 2000 we're negative by 0.4%. Under surveillance this morning, easing the tariff sting.
We're going to be taking in a tremendous amount of money. We're going to be taking in a lot of jobs, a lot of plants and factories. They're already coming. I mean, you see it. And we're going to make a lot of money, and we're going to cut taxes for the people of this country. It'll take a little while before we do that. But we're going to be cutting taxes. And it's possible we'll do a complete tax cut, because I think the tariffs will be enough to cut all of the income tax.
So here's the latest this morning. President Trump saying tariffs will allow him to cut taxes for people making less than $200,000 a year. Bloomberg's Tyler Kendall joins us now for more. Tyler, pretty aggressive stuff from the president. We talked about it in the last hour. Talk to us about how aggressive the timeline is for this tax plan.
Yeah, hey, John. Well, the stakes are clearly rising amid a flurry of polling over the weekend that shows that Americans are growing increasingly concerned with President Trump's economic plans. But those economic plans have always been staked on a twin agenda of tariffs followed by tax cuts. But amid fallout with the former, it's clear that this White House would like to see the latter get done as soon as possible, even as President Trump dismisses the polling himself. Now, some in President Trump's orbit have floated that they could see this done as soon as Memorial Day. That includes House Speaker Mike Johnson. But that is considered to be a very ambitious timeline. We could get firmer guidance on exactly where lawmakers are aiming when the Treasury Department updates its X date. We are expecting that potentially in the next week or so as they update that number as more tax receipts do come in. So that could potentially spur some fire here to try to get lawmakers to move more quickly when it comes to President Trump's tax cut agenda. But there is still just so much for these lawmakers to decide on. We're talking about tax cuts, of course. Congress is back in session today, where they are going to start working on crafting that reconciliation plan. Right now, they're working off of the Senate budget blueprint that allocates about $5.3 trillion in net tax cuts. It's likely enough to make permanent the 2017 tax cut plan and could include some other priorities. But there is just so much on the table, including no taxes on tips, overtime pay, and Social Security. And we also have to keep in mind, John, they are also talking about those spending cuts. And that's also going to be incredibly difficult amid concerns that there needs to be, one, more pay-fors for the tax cuts, and what that could, two, mean for potential cuts to Medicaid. Keep in mind, Republicans are doing this through the reconciliation process, which means they really have no room for error here because they are not going to court Democratic votes to get this done.
Tyler, who holds the leverage when it comes to the different groups that Speaker Johnson has to cajole? The deficit hardliners, the individuals from New York and California that care about SALT, those that care about protecting all parts of Medicaid. Who has leverage?
At this point, it really does appear that they all are making their voices known, though we should say that since they have agreed on the Senate budget blueprint, it does appear that those fiscal hawks, those conservative fiscal deficit hawks, did actually acquiesce in some sense here, because they had wanted in writing that there would be steeper spending cuts in order to get them on board with crafting the reconciliation bill. Ultimately, that didn't happen. Instead, they just got House Speaker Mike Johnson's word that there will be more spending cuts. President Trump himself has said that there would be more, in the ballpark of potentially $1.5 trillion. So we're going to have to see how this evolves. But it's clear that all the players really do want to have their voice made as they go to the table with this White House. Now, House Speaker Mike Johnson is expected to help kick off those negotiations today. He is expected to be in the Oval Office around 2 p.m. Eastern. As of now, it's closed press, but we'll be watching it closely because I'm sure they'll want to share an update if there is any movement on this.
Tyler, thank you. Tyler Kendall in the nation's capital down in Washington, D.C. To extend the conversation, Henrietta Treyz of Veda Partners joins us now for more. Henrietta, just what is achievable with this tax bill and this timeline that could roll through the next several months or so?
Yeah, my base case expectation is that we'll get this tax bill passed in late July. We're really waiting on Treasury Secretary Bessent's announcement about the X date for the debt ceiling. That can be a significant point of leverage for Speaker Johnson to twist arms and get what will be a very, very difficult and politically painful bill through the House and then potentially the Senate as well. It's unrealistic to anticipate that this bill will pass by Memorial Day. I know investors have been saying, hey, I've heard speculation that this could all come together really quickly. You know, those were topics of conversation that I was having with them a couple of weeks back. That's obviously false. There's no path to that. We're going to need several more months at least to get this bill to the president's desk. My base case is July 24th. And then, you know, secondarily, I really appreciate the president saying that he needs to do quite a bit more in this tax bill to make it a tax cut. because as Tyler just pointed out, this is mostly an extension of the same rates that have been in place for the last 8 years. So they need quite a bit more here to be either stimulative or timely.
Henrietta, the sense I got from the Treasury Secretary is that the X date is going to determine almost the timeline because they're going to make sure that they can raise the debt ceiling in reconciliation. Do you still see it playing out that way on Capitol Hill?
I really hope it does, because this is really a tricky bill. If you're going to try to cut $600 billion or so from Medicaid, $230 billion from SNAP, another $330 from the education programs, there's a lot of senators, I can list 9 right now, who won't vote for that. So what you really are going to need is some sort of existential crisis to get members to vote for this package. And the great existential crisis we have right now is the potential for a debt ceiling default. And so the hope for Treasury Secretary Bessent, as well as Senator Thune and Speaker Johnson, is that they will have that sort of Damocles hanging over members and get them to come to the table on things like the fact that the SALT cap will not be as high as Mike Lawler and other New York Republicans would like to see it. The IRA is not going to be fully repealed, for example. They don't have enough room to do no taxes on Social Security, which is $1.8 trillion. So it's really helpful from a leadership perspective to have that tool to go into negotiations with and force members to the table at the end of the line.
Basically, they need a cliff for President Trump to pull them back from. When it comes to the things like the deficit hawks, there's individuals like Mike Lawler who's pushing for a higher SALT cap. When it comes to those different groups, who do you think blinks first?
Well, I also agree with Tyler on this one. It has to be the senators who win the day. The House conservatives, the Chip Roys of the world, are going to have to either vote against this bill or acquiesce to the Senate's demands. What's underappreciated right now is that Senator Thune has a 2-seat majority to operate with in the United States Senate, because I suspect that Rand Paul will not vote for this bill in the event that it includes the debt ceiling hike of $5 trillion, which is what's in the Senate budget. And on the House side, Speaker Johnson has anywhere between 4 and 7 votes to lose. So what that means is that, unlike the beginning of this year, right now, the senators have all the control. They have the slimmer majorities. They have the margins that the House will need to tolerate. And of course, their budget is starkly different. I am biased as a former Senate staffer to think that the senators will win, but that's because they always do. So that's my base case.
Henrietta, over the weekend, we saw a slew of polls that showed a real deterioration in public support for tariffs and for some of the plans that President Trump has put out there. Does that matter at all to Congress members and their willingness to vote for this tax plan?
Yeah, it's a fascinating question, Lisa. I'm trying to track the data for everybody on our side as well, because the polling has been so precipitously dropped off. You've seen a net 6-point swing just since November away from the Republican Party. And that's not just for the president. That's for all of generic Republicans, which, of course, is what we're going to go into this midterm working with. So David Wasserman at the Political Report, that is an excellent at House prognosticating, puts 39 House Republican seats at risk due to the current polling data and the special elections in Florida's 1st and 6th districts. So this is a very serious problem. What we need to think about is the end of primary season, where Republicans have to run as close to President Trump as humanly possible, and then getting into the general, which starts in a couple months. And at that point, they need to distance themselves from the president in order to get through a general election cycle that has Democrats, independents, and Republicans all voting. So that's really the needle they have to thread. Right now, they stay as close as they can to the president. But later on in the year, they might drift away to try to win a general, which is going to be really important for the senators from key states like Maine and North Carolina as well.
Henrietta, thank you. Henrietta Treyz there of Veda Partners. Important final point. Deutsche Bank's Biggie Charter basically saying that the 6150 is looking for year-end depends on a credible relent on trade, and that credible relent is driven by exactly what you brought up, softer polls.
That was what a lot of people think the ultimate check will be at a time where it has not been the stock market. Occasionally, it's a yippee bond market, and it certainly isn't blowback when it comes to a number of people on the other side of the aisle.
The stock market's softer this morning. We're down by 0.2%. Up next, Mark McCormick of TD on Election Day in Canada. After 4 days of really powerful gains on the S&P 500, the losses for the month of April were down 1.5%. Since April 2nd, the S&P down just 2.6%. Equity futures this morning softer by 0.1% on the session. On the Nasdaq, we're down by 0.12. With 2 hours until the opening bell with your morning movers, it's Danny Berger. Hey, Danny.
Hey, John. The biggest loser on the S&P 500 pre-market so far is Eli Lilly, only down 1.6%, but it got a double downgrade from HSBC, rating it as a sell, saying that the risk reward is no longer attractive. All the optimism is priced in, and maybe too much in terms of things like market share, also pointing out that there is economic sensitivity to the rate at which people adopt GLP-1s. Also on the downside in the S&P 500 this morning is Nvidia, the second worst performer after Eli Lilly, down nearly 1.5%. A Wall Street Journal story over the weekend saying that Huawei is getting closer to developing chips that can rival that of Nvidia. Still early stages, testing still needs to be done, but it just shows that continued challenge to some of the American tech exceptionalism. Now, finally, we had Domino's Pizza earnings out in the last hour, though shares off some of the lows, but still down 2%. A really weak showing when it came to domestic sales. Domestic same-store sales fell more than 0.5%. The expectation was that they would grow 0.33%. International markets, those look strong. Really the only thing that held up the results for them. And the CEO of Domino's Pizza, like so many executives have said, that macro uncertainty is weighing on the chain. John.
That stock is down by about 2% of the pre-market. Danny, thank you. More from Danny later this morning. On our radar this morning, a battle for influence. Pressure ramping up on the Panama Canal. China dialing up scrutiny of a Hong Kong billionaire's plan to sell Panama ports to a group backed by BlackRock, while President Trump is calling for, quote, free of charge passage for U.S. ships.
So here we have a scenario where basically President Trump is saying we need to make sure that the United States gains all control of those ports in Panama Canal. And what happens? BlackRock says we can make that happen for you. We're going to buy these ports. And China's saying not so fast. The regulator coming out saying nothing is going to happen with Li Ka-shing and selling of these ports until the regulator releases it. Also, Bloomberg reported in March. Recently, we've heard the CCP told state-owned firms to hold off on any new collaboration with businesses linked to Li Ka-shing or his family. So they're going after Li Ka-shing and his family right now. Potentially, this deal just completely falls apart.
The president is very good at putting things on the radar that you typically wouldn't hear about. And this is one of them. This is a national security issue. And it's gained greater interest over the past few months because of one man in the White House.
And a lot of people agree with him in terms of free passage for the Panama. And he talked about the Suez Canals, but this has to do with the Panama Canal in particular. Interestingly, BlackRock, Larry Fink, in an economic club speech earlier this month, said he still has a real conviction that it's going to get through. It's a 9-month process of oversight. A lot of things can happen. But it feels like it's increasingly become a pawn in this larger debate of a trade war between the U.S. and China.
Let's build on that trade war. The latest from Shein, hiking prices by as much as 377% ahead of tariffs on small packages. E-commerce giants are facing a 120% tariff on their products when the U.S. government ends the de minimis exemption on Friday.
Okay, the headline was hikes prices as much as 377%. And then when you look into the details, there is a thick hand towel that you can have for your kitchen that was increased in price by 377%. Let's talk about what these prices are too. And I think that that's actually really important. We're talking about a razor holder for no drill shaving rising from 46 cents to now $1.11. So that's a rise of 141%, but it still is a very cheap product. The question is that going to be enough for people not to order from Shein, and whether people will absorb that? Because on the margins, maybe they'll say, OK, we can buy those $6 hand towels, even if they've increased from $1.25.
The trade is collapsing and the price hikes next, and this is something we're all tracking at the moment. Also tracking this, a rare morning White House press briefing this morning. Press Secretary Caroline Leavitt expected to speak alongside the border czar, Tom Homan, at 8:30 Eastern Time as they look to mark 100 days. And most people would say that this is one of the issues that the president has had great success on. This is what they voted him into power for, to shut down the southern border, and border crossings have collapsed.
Absolutely. When you look at the polling right now, what you see is the president isn't doing so well when it comes to the economy or this ability to lower prices, but the American people do like what he's doing on immigration. I imagine part of this before the market opens press briefing, which honestly never happens, a press briefing at 8:30 in the morning, let alone anything before noon in Washington, D.C., that they're trying to also make sure they're getting ahead of a narrative. Over the weekend, there was an undocumented individual, not an American citizen, deported to Honduras, but had children as young as 2 years old that are American citizens but deported with her. And I think they want to try to set the clarity on this, because Tom Holman was asked about this on the weekend shows, and he says the first time I'm hearing about this case specifically, but we do not deport American citizens, but the mother will choose to take her children with her.
That news conference takes place in about 55 minutes. When we get the headlines from it, we'll share them with you. I want to turn to Canada. An election reshaped by President Trump's trade policy. Prime Minister Mark Carney looking to lead the country's Liberal Party to a victory against Conservative Pierre Poilievre. Joining us now from Ottawa is Bloomberg's David Gura. David, welcome to the programme. Always good to get your thoughts. This election race has changed a lot. How much has this changed in just a few months?
The political terrain has shifted radically over these last few months. If you go back to the end of last year, when Prime Minister Justin Trudeau's political hold began to get very tenuous, there was an expectation among the Conservatives in this country that this was going to be a change election that centered on economic issues, so centering on tax and the wide unavailability of affordable housing, for instance, debts and deficits. And while that's certainly the backdrop to this election today, it was the reemergence of Donald Trump, his re-entry to the White House for a second term, that totally upended the election that's taking place in this country. And Mark Carney, the Prime Minister, has been able to capitalize on that going into the election today, presenting himself as a figure who is best positioned, in his words, to deal with Donald Trump, based on his experience having navigated major crises before. So, of course, he was the governor of the Bank of Canada back in 2008 during the global financial crisis, and in that position took a real leadership role in the G7, helping the world economy navigate that crisis. He moved from there to England to lead the Bank of England, of course, when the Brexit vote happened. So he's calling upon that experience here, telling voters he's the person who knows how to navigate a major global crisis like this one. And I mentioned the role that Donald Trump is playing here. There was a moment when it seemed like a joke when he would talk about Canada as the potential 51st state. It's fair to say that joke didn't land, and Mark Carney has said from the get-go here he never thought that joke was funny. In fact, he never thought it was a joke. He took him seriously from the very beginning. So those two issues are really salient here with voters today. The issue of a threat on sovereignty of this country, and the second issue on trade and how this country will negotiate with, communicate with, push back on Donald Trump as this trade issue continues to heat up. It's been interesting to watch over these last few days how those polls have narrowed. Not only have Liberals gained that ground that they lost to Conservatives over the last few months, they've surpassed them. It has ebbed a bit, and I should mention there was this tragic incident over the course of the weekend in Vancouver, a vehicle ramming in British Columbia that killed 11 people, injured more than a dozen others. And we saw the way that changed the contours of the campaign yesterday. Jagmeet Singh, the head of the New Democratic Party, was at that event just a few moments before that occurred. It changed the tone and tenor of this campaign. Mark Carney scaled back a number of the events that he did yesterday, and he had to kind of navigate these dual roles. Yes, as the sitting prime minister and as the candidate for that job going forward here. So folks, go to the polls today. They've just opened, and of course, this is a vast country, a large geography. Polls will stay open until about 10 o'clock tonight. But all of the candidates have returned to their ridings, their districts, John. That's where they'll be over the course of the day. They have events here in Ottawa for both Mark Carney and Pierre Poilievre tonight. We'll see who comes out on top. But looking at that most recent polling, at that public opinion polling, it seems like the Liberals do have the edge going into the campaign in the election today.
David Gura, looking forward to your coverage, sir. Thank you. David Gura up in Canada throughout today for that election. The move we've seen in the polls has been absolutely amazing, dramatic. At one point earlier this year, the Conservatives had a 20-point lead. Poilievre was destined to be the next Prime Minister. Things changed fast.
Things changed fast when the president starts truthing that he wants to make Canada the 51st state. And then what did you see? You see arch rivals in Canada, in provinces where individuals really didn't get along, all start to coalesce on, well, we need to stand strong against Trump. And now what you see in Canada is basically these individuals that are thinking maybe it's time to switch course. We're going to go for a conservative, are saying, nope, we're going to stay the course and go for someone who we know is likely going to maybe stand up for Canadian interests and not be conservative in nature, maybe on the same side at points with Trump.
To build on this, Mark McCormick at TD Security joins us now for more. Mark, welcome to the programme. Before we get to the politics, I want to talk about the economy. What position is Canada in at the moment? How is the trade volatility, the policy volatility south of their border started to infect their economy?
Well, I think what's interesting is you bring it back to the markets and the economy is that Canada is actually the playbook for probably Europe and partly Asia as we think about trade uncertainty and as it filters through. If we go back to the start of the year, the whole focus on trade uncertainty and tariffs and all these things that were unleashed basically came to Canada and Mexico first. So this was a North American story. So you can see how things have progressed. The Bank of Canada has cut rates more aggressively than other central banks. They had to do it first, but they're nearing the end of the cutting cycle. So the interesting thing is the market's kind of picking up that one of the main drivers for macroeconomics and currencies and rates is a shift from monetary to fiscal policy. And that is a theme that has been driving markets we've called it a vibe shift in terms of what markets are focused on and how they want to think about the vibes are changing over time. But I think an important thing for Canada is they've already gone through a lot of the uncertainty and volatility that comes on this trade side. So we're seeing what it looks like on the other side. And what we see is a transition from the central banks cutting rates to fiscal stimulus taking over, and the currencies and volatility and positioning all starting to respond to that.
So just to put that more plainly, Mark, is that the reason why you have seen dollar weakness, even as the Fed is more likely to hold rates firm while the rest of the world cuts rates in response to disinflation?
This is the $1 million question in FX, because what's interesting is that inflation expectations are rising. You look at 1 year, 2 year inflation swaps pricing, and it's going higher. We know that inflation, core PCE, is going to be running at least 4% in the next couple of months, maybe if not for a little bit longer. So what the market's thinking is that the Fed could see through this. And I think this is the biggest debate, because there's so much uncertainty for the next 2 years, the next 3 years. We have no idea where any of this is going. We know that globalization is moving backwards. We know that this feels, again, like a mini supply chain shock like we had during COVID. So the central bank response is critical. And I think it's very important as well, because Trump has been coming after central bank independence, and he's been coming after Powell. How did they react the first time this happened? They actually hiked rates. They were more hawkish. They tried to assert their independence. So I think the market has no idea what the Fed's next move is. And again, the thing that we are all back to data dependency. So we have to watch the hard data. We got payrolls this week. So keeping that all in mind, I think, the number one thing we want to focus on is that U.S. is going to deal with higher inflation and weaker growth. But right now, inflation seems to be more prominent.
Well, Mark, if you look at the hard data, though, that leaves the Fed with what, being on hold the rest of the year?
No, we anticipate that they're going to cut, but it could be backloaded. Again, you see more aggressive cuts in the back end of 2025, and you can see a lot more aggressive cuts coming in 2026. But whether or not the Fed could cut in the next 3 months, I think is going to be, again, very dependent on the data and very dependent on how market pricing evolves around these changing narratives. I think the thing you want to think about is the growth shock, just like we just talked about in Canada. The growth shock is going to land in Europe first. It's going to land in Asia first. So again, if you kind of think about what curves should be doing and what currency should be doing, we probably should have in the very, very short term a little bit of consolidation of dollar, a little bit of a weaker euro, because we should see front-end pricing in Europe, in the UK, in euro move lower on the 2-year interest rate differentials.
Hey, Mark, appreciate the input from you. Mark McCormick there of TD Securities on the FX market. At least we've seen a lot of rebalancing to guess where? To Europe. And Mark's basically saying that's where you're going to see the pain first.
Which is ironic, considering the fact that a lot of people are thinking that this is good for both fixed income as well as the equity markets. Did you see Switzerland? People are basically expecting negative rates there because they are concerned about how strong their currency has gotten. So right now, it is so strange to try to understand the traditional paradigm of more rate cuts means a weaker currency, because something odd is going on that makes it very hard to understand exactly what the driver is going to be.
There's nothing traditional about the market regime at the moment, that's
Amen.
for sure. Euro dollar 113.45. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. Most of Spain and parts of Portugal were hit by a major blackout at around noon local time today, impacting power and phone lines. Public transport, traffic lights, and phone services were mostly down in parts of Madrid, Barcelona, and Lisbon due to the outage, and trains were mostly halted. The reason for the outage is still unknown. Meanwhile, a series of new polls suggest discontent with President Trump's economic plan among U.S. voters is damaging his popularity. A CNN poll released yesterday found 39% of Americans approve of how Trump has steered the economy, and an NBC poll also showed only 39% of respondents agreed with his tariffs rollout. And in sports, Liverpool are Premier League champions for the second time after a commanding 5-1 win over Tottenham. The win seals Liverpool's 20th top-flight English League title, matching the record of their rival Manchester United. It's the culmination of a career year for first-year manager Arne Slot and superstar Mo Salah, who leads the league in both goals and assists. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for that. Winning it at Anfield, pretty special stuff.
It was a shellacking in their own field, I think is fair to say, and the celebration was pretty fun to watch. I've got to say, their dance moves, sort of, very
You're impressed by that?
Yeah, really,
Nice.
all of them going together.
Pretty brutal for TK's Tottenham, that's for sure. We'll leave that there. Up next on the programme, making the bond market great again.
The important thing is that we are setting the fundamentals for a strong dollar, a strong economy, strong stock market, and for investors to know that the U.S. government bond market is the safest and soundest in the world.
We'll get a view on that in just a moment. On the debt market, Amanda Lynam of BlackRock from New York City. You're watching Bloomberg TV. Equity futures on the S&P negative here by 0.1%. On the Nasdaq 100, just a little bit softer as well. Big week for the Nasdaq, tons of earnings. You know what the calendar looks like. Wednesday, Meta and Microsoft. Thursday, Apple and Amazon. In the bond market this morning, yields just a little bit higher. 10-year yields up by 4 basis points, 4.28 on a 10-year. Under surveillance this morning, making the bond market great again.
Anything that happens over a 2-week, 1-month window can be either statistical noise or market noise. And we're in this for the long term. And the important thing is that we are setting the fundamentals for a strong dollar, a strong economy, strong stock market, and for investors to know that the U.S. government bond market is the safest and soundest in the world.
So here's the latest this morning. The Treasury Secretary looking to reinforce confidence in U.S. debt and put a floor under the recent sell-off. Amanda Lynam of BlackRock writing, we see scope for additional spread widening and credit. Underpinning this view is our expectation for a more challenging growth inflation mix, as well as our expectation that the hard economic data will eventually catch down to the soft sentiment data. Amanda joins us now for more. Amanda, good morning.
Good morning. Thank you for having me.
Eventually. Can we put some details on eventually?
So I think taking a step back, the market seems to be taking a bit of, I would say, a temporary reprieve from the fact that we haven't seen this soft data translate directly into hard data immediately. If you actually look at what these companies are saying, though, which even the companies over the last 7 days of reporting haven't really baked in expectations of shifts in trade policy. And so I think actually where we're looking for is the second half of this year. If you look at home builders, they're not expecting higher costs to hit closing until the third quarter or fourth quarter. Industrial companies aren't expecting higher costs until they work through inventory, possibly to the second half of this year. So corporates are, I think, still figuring this out to a large degree. So it's not surprising that we haven't seen it in the hard data yet. I think just because we haven't seen it in the hard data, though, doesn't mean that it's not eventually in train. And so we are bracing for that. But I would say it's probably going to be a second half of this year.
Some of the hard data, of course, flattered by front loading. We saw that in retail sales. And I think you see it in earnings as well to some extent. How are you distinguishing between genuine underlying demand and just a stockpiling, getting ready for supply not being there?
So I've spent a lot of time in company earnings call transcripts, and they actually are even having a really difficult time figuring out what is front loading and what is actually real demand. I think it's going to be a matter of time before we see that play through. But even in the autos, for example, we did see a really large jump in auto sales. I think you can kind of put the mosaic together and figure out that that is some front loading. But I think when we take a step back at corporate credit markets, high yield spreads, for example, have retraced 47% of the widening since mid-February. It's been striking how quickly these markets are kind of mean reverting. So investors, I think, are getting these opportunities to put money to work at more attractive spreads, but they're becoming short-lived. They're snapping back. We don't think we've seen the end of that. We're around 360 in high yield spreads. In order to bake in a real material growth slowdown, we would need to be 550, 650. A recession would be even above that. A recession's not our base case, I should say.
Just to put some numbers on that, on April 8th, the average yield on high yield bonds was 8.7%. It is currently down to 7.8%. Just massive snapback as everyone piled in. I want to understand the buying dynamics. How much you're seeing the buyer base for credit instruments shift, maybe away from the foreign buyer, away from the Japanese, away from the Europeans, and toward a more domestic audience.
So foreign investors own around 1/4 of the U.S. corporate bond market. So it's not just treasuries or equities. They also own corporate debt. I would say the marginal dollar has been been in place to reallocate to European credit for a couple of years now, ever since the ECB started hiking rates, because you had some yield buildup in that market. I would say on the margin, given some of the optimism around the fiscal support, there is incremental interest in putting money to work in Europe. It's tempered by two things, however. One, the growth backdrop in Europe isn't great either. And so we are expecting some headwinds from shifts in trade policy. You can see that, and even some of the survey data from Europe. And two, the U.S. corporate bond market is the most diverse, deep, liquid market for corporate investors. So if you're looking for high quality spread product, there's not a lot of availability in Europe. So I think by that extension, investors will still need to allocate a significant amount to the U.S. market.
Which is the reason why you haven't seen the numbers fall off that much. I wonder how much of competition the credit market is getting from the Treasury market. The fact that the U.S. Treasury Department is going to be announcing their quarterly refunding estimate today, and then on Wednesday, their actual schedule of issuance. How much is that creating a real challenge for you in understanding the dynamic going forward for how the fair pricing of credit really works?
So related to this is part of the reason why we like actually moving down in quality in Europe, in U.S. corporate credit. For this reason, the Treasury market has been very volatile. We're expecting steeper curves. We're expecting a rebuild in term premium. For that reason, we think it's important for investors to capture the additional spread premium where they can in corporate credit to kind of offset some of that volatility and boost those total returns. Actually, parts of high yield have outperformed investment grade on a total return basis so far this year, and even the lowest quality portions of high yield have outperformed the equity market. So actually, the credit market, even though it's been a really volatile year to date, is still offering a bit of a reprieve in terms of total returns because of that spread pickup. If you move down into the high end of high yield, you're not actually foregoing that much credit quality relative to, say, for example, the low end of investment grade. So we do like moving down in quality a bit to pick up that extra spread premium to kind of cushion those total returns. As for the competition point, we're just bracing for a significant amount of Treasury supply. That's been a theme for the past several quarters. We know that because of the deficits. But I do still feel that corporates recognize the difference between the sovereign risk and the corporate credit risk. There's still a really significant need for corporate credit allocations. But I think really the name of the game is actually duration has been very volatile. We're better off allocating to credit for carry and income, so favoring that short duration and picking up spread when you can.
Are you seeing investors abroad discriminate between the two, between sovereigns, between treasuries and, say, corporate credit in America?
For sure. I think the allocation to corporate credit is really in its own bucket. I think the decision for investors really from our conversations has been twofold. Am I investing for total or excess returns? And so where am I aiming in the credit quality spectrum? Am I aiming for duration or not? And then also the relative value, as you alluded to, Lisa, across regions. The other tricky thing for Europe is that valuations haven't reset that much. So if you are allocating that marginal dollar to Europe, the valuations haven't given you a great entry point at this point.
Certainly at times this month it's felt like all US assets are trading in one bucket. Day to day.
Which it has, except not when you look under the hood. And what you've seen even in the flows is that, yes, foreign investors have been shifting away on the margins from treasuries, but not credit, because of some of these ideas. And that's why people could say we can still get around some of the corporate story in the U.S., but maybe not the government story right now.
Amanda, it's good to see you as always. Thanks for dropping by. Amanda Lynam there of BlackRock. Equities at the moment just a little bit softer. We're down just 0.1% on the S&P 500 as we commence a brand new trading week following a decent week of gains on the S&P, a week of gains north of 4%, and over the last 4 days, a gain of more than 7%. Up next on the programme, we'll catch up with Seema Shah of Principal Asset Management. We'll speak to Angelo Zino of CFRA on a big week for Mag 7 earnings. Neil Dutta of Renmac and Lotfi Karoui of Goldman Sachs. From New York, this is Bloomberg.
Short-term volatility that then can resolve itself. The concern is if we cannot have some certainty in the markets.
This markets are looking for certainty, they're looking for direction.
The U.S. markets are still the most liquid and the deepest.
Nothing is safe. Everything is a risk today.
This is not the time to get out of the market, right? You need to play this out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now. We've got a big week ahead and we're rallying hard into it. Equity futures this morning softer, but following a powerful 4-day rally on the S&P 500, gaining by more than 7% over that period. The S&P a little softer, the Nasdaq 100 as well. Over the previous 2 weeks, bond yields down, lower on a 10-year. Some comfort coming from fixed income as we stabilise. A 10-year Treasury around 430, up this morning by 4 basis points, 427.97. Something for stock traders and bond traders alike throughout the whole of this week. Lots of economic data, concluding with payrolls on Friday. Lots of earnings as well. Meta and Microsoft on Wednesday. Amazon and Apple on Thursday. Listen to this for a 4-day performance. Apple up 8%. Microsoft plus 9%. Lisa, Meta up 13% over just 4 days.
The bear market in big tech was really called into check when you got some of the earnings last week, which showed that the AI investment cycle is still going strong and that people were still paying up for advertising across the board, but particularly with Alphabet. Abby Yoder of JPMorgan Asset Management put it really well when she said everyone seems to have left AI and the AI trade for dead, but that is the reason why they see a pathway for some sort of rally into year end, because she sees Microsoft, Meta, Apple, and Amazon all just reflecting this big tech spend and continuing to deliver profits that really underscored the American exceptionalism that everyone seems to be bailing from.
And it's happening as the president tries to change the conversation from punishing allies and trade partners to striking deals with them. And now, alongside that effort, pushing to deliver a tax plan and deliver it fast.
And it makes sense, right? Because what you see in a lot of the polling, a lot of the surveys, is that Americans are very concerned. There's a lot of consternation about what the tariffs may mean. Price and hikes, does this mean we're going to have empty shelves? So push the conversation forward to tax bill. They want to get this tax bill done Memorial Day. That is in 1 month. And no one really thinks that's going to happen. But while there's a lot of optimism coming from the Treasury Department and the White House, when you look at Congress and the composition of how slim these majorities are, this is going to be an incredibly challenging tax bill unless it's just the extension of current policy.
The more consumer sentiment moves against them, the more the market pressure continues to build, the more price hikes start to be announced from corporate America, the more the pressure will build on Washington, D.C. to act and provide an offset. Equity futures this morning on the S&P a little bit softer. We're down 1/10%. And coming up this hour, Seema, Shah of Principal Asset Management as stocks look for a second straight week of gains. Angelo, Zino of CFRA with more Mag 7 earnings on deck. Huge week for big tech. And Renmax, Neil Dutta on the rug pull to the consensus view. We begin this hour with stocks steady as traders await a busy week of earnings and data. Seema, Shah of Principal Asset Management writing, without a meaningful step back in tariffs and in the absence of growth boosting measures, the US economy would slide into recession. Seema joins us now for more. Seema, welcome to the program. Let's talk about big tech with that in mind. How resilient are Mag 7 earnings in the face of cyclical risk?
Hi, John. Well, I mean, there is some resilience, as we were talking before, in terms of the amount of capex. I think people are still not necessarily questioning the long-term growth potential of these companies, but they do sit in the eye of the storm with regards to tariffs. I mean, when we're doing the sectoral analysis, technology is the sector which is most vulnerable to the various tensions. Now, we are hearing from investors that they're looking to maybe dip their toe in the tech trade again, given the very big re-rating that we've already seen. But I guess that we'd be a little bit skeptical at this point that there isn't further downside to go for these tech firms.
Seema, the price that people are willing to pay on US assets right now, valuation in question, but also international exposure, which is something you've touched on, something you've talked about. Can you build on that for us? International exposure for the likes of Apple, is that going to be a plus or a negative for this quarter?
I think when you're looking back at Q1, I think it's still a plus. It's when you're really starting to look out, just like it is for any of the other earnings guidance, earnings calls that we're going to be hearing over the next week or two. It's really about what goes forward. Now, from that perspective, particularly regards to China, we have got growing concerns. Even for Europe, we're now expecting recession for the euro area, for the larger economies there. So I think it is still going to be a really challenging quarter ahead. I think the question is for a lot of investors is that we know that the short term is going to be very challenging for a number of companies, but they're still putting a lot of weight on the long-term potential, what they believe is still a sustainable story.
Seema, how much credence do you give the Sell America trade? This idea that people are souring on the U.S., both bonds and stocks, at a time where there's a lack of clarity and already a pretty expensive valuation that's been baked into equities?
Well, I think it's a big discussion. I mean, I was in Berlin last week, at a conference just talking to investors, and I think there is a growing feeling, concern about where the US is going. But when you really dig deeper into where are they going to allocate, they do believe that it makes more sense to think about the marginal dollar coming back to Europe, especially given currency considerations. But no one is really testing the idea that in the long term, the US is still going to be a key player. So it's a conversation, of course, since there's a conversation. And if the Trump administration were to pursue the tariffs along the line that it already has in the last couple of months, then that question starts to become a bit of a roller coaster. And as it gains momentum, that becomes more concerning. But I think in the short term, it's just an interesting discussion rather than really questioning what the future of the US is in terms of US exceptionalism.
About 2 weeks ago, we saw that toxic mix of both bonds and stocks in the United States selling off in tandem. And suddenly people were questioning the idea of treasuries as a haven asset, the idea that they would have to seek gold or maybe boons as a possible alternative. On the margins, are you starting to shift the concept of what the ballast of your portfolio will be away from the idea of full faith and credit in the U.S. government?
I think that to an extent, yes. I think when we're thinking about the asset allocation, international starts to look more interesting. And when I say international, look, we've always had global diversification, but it's the specific regions which have suddenly become more interesting again. So specifically Europe, again, in the near term, we do believe a challenge, but into 26, 27, things to start to look a little bit brighter. So I think it's a combination of the US looking a little bit more concerning, but also the attempts by a lot of governments to reshore their economies. We're hearing more and more of these headlines. So it does mean that from an international perspective, there are more opportunities, and I think that is starting to play through. But it doesn't necessarily mean that investors are going to be aggressively moving away from the US. It's just that the world is a bigger place.
Seema, how do you sort of filter out the noise that we're going to be hearing on a consistent basis, whether it's from Washington, D.C., or whether it's the stacked calendar this week of earnings, of economic data, as well as potential corporate actions? How are you filtering this out and understanding what to pay attention to the most closely?
So I think for this week, when it comes to the macro data, and I think a couple of other people on your program have already said this, which is that the soft data, we know it's dire. We don't see any chance that in the near term it's going to improve. The question is really going to be what happens to the hard data. And I don't think the payrolls report this week is going to give us any early indication of what's to come. So I think that this week we're going to get through it and probably not know anything more than we did at the beginning of the week. When it comes to earnings, it's a similar story. It's really about what the forward guidance is, what are companies doing with regards to tariffs. So actually, I think in the near term, we're not going to know much. It's really once you get towards June that we potentially could have some idea of where things are going. And of course, at the end of the day, the only thing that really matters is what the Trump administration is going to be doing. When we're thinking about the economic forecast, we have a huge amount of uncertainty built into that because it really does depend on what they do with tariffs and specifically what they do with tariffs to China.
Policy and policy driving this equity market. When it comes to what the market likes to hear, they like to hear the idea of the United States and China sitting down for negotiation. We sometimes see the market react when Trump puts out these truths or an interview says he's spoken to Xi Jinping. But most believe that that conversation actually hasn't happened. Why does the market like something that maybe not be credible?
Well, I think the key thing here is that the market is just hoping that we've got the worst of the tariff story behind us. And so from here, even if it's a very, very gradual upward trajectory, at least it's an upward one. The other thing that we are hearing about is, when you look at the effective tariff rate and how much it's increased because of the 145% tariff on China, that's all that matters. So the key thing that investors are focusing on is not necessarily discussions with Europe, discussions with Japan or India. What they really want to know is anything to do with China. So any bit of good news is going to be received positively. Now, to your point, it doesn't necessarily mean that anything's actually going to happen. So there is going to be that continued volatility. But that is the key point of news that we're going to be looking out for over the coming weeks, months, and unfortunately, potentially quarters too.
But Seema, at the moment, this is just noise. And this is just, an olive branch that they want to come to an agreement. The fact of the matter is there's a 145% tariff rate on imports coming to the United States. When is the market going to really start to absorb that?
Well, I think it's once you start to see the economic data deteriorate, we've been talking about empty shelves. Those are the kind of things that it will really hit home that there is a meaningful deterioration in the relationship. But still, one of the reasons that we haven't come out of equities, that we're still in risk assets, is because there is a potential for a positive headline. This is not probably the time to be closing out your positions. There is still the potential for upside. And I think investors, when we're looking at the economy coming into Q2, it still looks fairly robust. And if you have a fairly robust economy, plus potential for any positive announcements, that is the time that you still want to have exposure.
Seema, appreciate it as always. Seema Shah there of Principal Asset Management. I think for investors right now, it doesn't matter whether the talks are happening or not. It matters that the president wants you to think they're happening because the president is looking for an off-ramp.
He's looking for an off-ramp. And also the Treasury Secretary has made pretty clear most recently this weekend, as well as an interview with me, that these rates are unsustainable. The issue is, when is that off-ramp going to be? Because if it's going to be soon, maybe the damage can be contained. What if it's in 6, 7, 8 months? It's going to be incredibly challenging for U.S. companies.
That's the risk, that you start to see it hit profits. You start to see it hit the economic data. We get more data this week, including payrolls on Friday. Equities at the moment on the S&P just a touch softer. We're down by 0.2% as we kick off a brand new trading week with stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Most of Spain and all of Portugal were hit by a major blackout at around noon local time today, impacting power and phone lines. Public transport, traffic lights, and phone services were mostly down in parts of Madrid, Barcelona, and Lisbon due to the outage, and trains were mostly halted, though the stock market continues to operate normally. The reason for the outage is still unknown. Meanwhile, the Vatican has chosen next Wednesday as the start of the conclave. More than 100 senior clergy members will take part in the process to choose Pope Francis' successor. Discussions and 4 rounds of voting will take place each day until a candidate receives 2/3 of the votes. At that point, traditional white smoke will be seen over the Vatican, signaling a new pope. And a series of new polls suggest U.S. voter discontent with President Trump's economic plan is damaging his popularity. This as he closes in on 100 days back in the White House. A CNN poll released yesterday found 39% of Americans approve of how Trump has steered the economy. And an NBC poll also showed only 39% of respondents agreed with his tariffs rollout. That's your Bloomberg Brief. John?
Yahara, thank you. On day one, they hit the ground running. They have not stopped. The pace has been absolutely unbelievable. Up next on the programme, the Morning Calls, plus Angelo Zino of CFRA with Mag 7 earnings in full swing. From New York City, this is Bloomberg. Absolutely stacked week ahead. Talked a lot about the earnings, payrolls as well on Friday. The estimate in our survey, a sneak peek, and it can change as we get more estimates. The median at the moment is 130. The response from the south side, Stuart Kaiser of Citi, an inline print is modestly positive, but with a soft print will likely be negative, and a sign that tariffs have pushed the economy on a path to recession. That's the risk for Friday. You get a negative print, this market will run in the other direction pretty fast after a rally of more than 7% in just 4 trading days. Equity futures this morning softer by 0.2%, down 1/4 on the Nasdaq 100. That's your price action. Let's get to some morning calls. First up, Truist upgrading Peloton to buy, seeing recovering fundamentals and anticipating revenue growth in 26. That stock is up by close to 5%. Your second call from Citi, cutting its price target on Under Armour to $6, citing tariff impacts and a weakening sales backdrop. And your third and final call, HSBC, double downgrading Eli Lilly, expecting economic sensitivity to impact weight loss drug adoption. That stock is negative by 1.6% in the pre-market. Let's turn to tech. Meta, Microsoft, Amazon, Apple, all reporting earnings this week. Angelo Zino of CFRA writing, we expect guidance to be conservative and may be deferred in instances given the low visibility tied to policy uncertainty. Angelo joins us now for more. Angelo, welcome to the program, sir. Let's just talk about the companies in front of us this week. Of all the business models, which business model do you think we should get exposure to, given the risks that we all face at the moment?
Thanks for having me, John. I think the one that's at most at risk would be Meta, as far as kind of deterioration from a macro perspective as a result of the tariffs that are being implemented here. So, but that said, I think Q1 results across the board are going to be fairly good. I think even Q2 guidance for those that do provide Q2 guidance are going to be okay. My bigger concern would be more in the back half of the year if we don't start seeing greater momentum in terms of deals and a pullback in some of the tariffs that have been announced. Because as far as Meta is concerned, when you think about Meta, they've got the biggest hike in terms of cost in 2025 versus 2024. And, they're also, I'd say, the most exposed in terms of macro factors, given they are, more digital ad focused.
Meta's rallied really hard into this print. It's up by 13% over the past 4 sessions, Angelo. Can we just sit on Meta and ad revenue? What is the difference between the profile of ad revenue over at Alphabet and the character of ad revenue over at Meta? Because the revenue story over at Alphabet was pretty decent. What's the difference between the two?
Yeah, I'd say historically, Alphabet's their ad-related revenue has been a lot more sturdy during challenging times. They're typically the last to fall because that platform typically has just much greater eyes. I'd also say, as far as Meta is concerned, a little bit more exposed in terms of smaller, mid-sized businesses, also more exposed from a percentage of revenue basis as far as some of the concerns related to the China e-commerce names, the Sheins, Temus of the world. So again, a little bit more exposure for Meta in some of those riskier aspects of the digital ad markets. Now, that said, the great thing about Meta is they've got some great secular and new revenue opportunities tied to them in 2026 and 2027. So the hope here for Meta is hopefully they can find some benefits on the cost side of things that allows them to maybe get through the next 6 to 9 months, and then investors, I think, will be willing to look past that and look into 2026 and those great opportunities ahead.
On some level, Angelo, do you kind of pair Meta and Apple together in terms of having a disproportionate exposure to China and the international footprint relative to, say, a Microsoft and Amazon, which I know you don't cover, but there is this feeling that maybe there is a bifurcation or just a segmentation of big tech, and we are going to see it in the earnings later this week?
I think that's a fair point to make. I think for Apple, clearly they've been kind of this poster boy child on the tariff side of things, and they are going to be more exposed because they are a hardware vendor, and they've got to talk the strategy more on the manufacturing side of things. I think at least that's what investors want to hear is China-related domestic exposure, which a lot of these other hyperscalers really don't have exposure to because they're not as entrenched in the local China market. So we want to hear what Apple has to say on that side of things. And then, of course, what they have to say in terms of shifting some of the manufacturing away from China, de-risking some of that here, whether or not it be over the next 3 to 6 months, more so over the next 2 years or so. So Apple probably a little bit more riskier in terms of the Apple play. But I think there's also a story to be made where Apple could benefit from the tariffs long term.
Please elaborate on that. What are you saying? That they can benefit from the tariffs long term? That sort of was a pretty wild card.
Yeah, so long term, when you think about it, the great thing about Apple is they have some great pricing power, right? They've got a great brand. They've got the pricing power. If there are tariffs that are implemented here in the second half of the year, which we expect, I mean, we need to wait for this 232 semiconductor investigation to really play itself out and see what those tariffs are. But, ultimately, Apple will have to increase prices, we think, to offset those tariffs. But over time, as we go into 2026 and 2027, Apple is going to be able to push back or roll back, we think, some of those higher costs by moving some of the manufacturing, also kind of maybe manufacturing some of the chip components in the U.S. Let's call it some of the processors with Taiwan Semi, and over time they're going to be able to roll back some of those higher tariff-related costs, and we don't expect them to pull back in terms of pricing. So ultimately, we think 2 to 3 years down the road, they could actually benefit from a margin perspective through higher tariffs.
This is fascinating to me, Angelo, and it has implications well beyond just this company. And it goes to the heart of the thesis that Abby Yoder was explaining earlier this morning of JPMorgan Asset Management, where essentially the Magnificent Seven, I don't want to say have been left for dead, but really saw a big drawdown. And all of a sudden last week, we saw Alphabet beat expectations, reaffirm the commitment to capital expenditure spending. How much do you expect that to be the tone this week as well, particularly when it comes to tech expenditures, the AI revolution, and how much some of these companies see in terms of opportunities going forward that maybe people have kind of ignored for a bit?
Yeah, no, that's a great question. I think overall, across the board, these companies are going to sustain their CapEx spending plans. And I think now that has kind of been, that's the overarching theme out there. I don't really see any change to that. I think where you could see some benefits or some pullback on the cost side of things is on operating expenses. When you kind of look here over the last kind of 18 to 24 months, what a lot of these mega cap companies have done is kind of shifted more, increasing on the expense side of things, on the CapEx, pulled back, or at least kind of been a lot more conservative on the OpEx side of things. When you look at a company like Meta this year, they threw out a nice jump on the OpEx side of things. I think high teens growth year over year. So we think there's the potential for them to roll back some of that, and that should help the margin side of things, at least relative to where some of the expectations are, where the expectations were already expecting for some margin compression this year. You saw some nice outperformance from Alphabet just last week on the margin side of things, because that is something that they are working on. So I think you see that across the board here over the next couple of quarters and frankly, over the next couple of years, where the focus is on those long-term investments, because AI is such a great opportunity, and it's something that these companies can't miss out on, because if they're not investing in it, somebody else will.
Well, Huawei Technology is investing in it. We have a Wall Street Journal story this morning that they're gearing up to test a new, very powerful processor when it comes to semiconductor space, which basically they hope that will replace what right now NVIDIA sells to China. Are you concerned about what that means for how much NVIDIA could be selling into Beijing?
Yeah, I mean, I think at this point in time, as far as NVIDIA is concerned, you've got to really almost put negligible revenue tied to China here over the next couple of quarters. I'd say less than 5% of their sales at this point are probably going to go into China. I think Huawei clearly is going to be the dominant factor in China as we kind of look 2-3 years down the road, just given what this administration is looking to focus on. I think there's another concern out there as far as the AI diffusion rules are concerned going into May. But when you look at NVIDIA's exposure outside of China, I mean, I think really kind of this GPU ban really takes out the risk of these AI diffusion rules as you kind of go into next month. So I think we're in pretty good shape as far as NVIDIA is concerned, as far as the worst case news being out there in the market.
Angelo, appreciate your input, sir. As always, good to catch up, buddy. Angelo Zino there of CFRA on the earnings through the week. You're familiar with the calendar. We've been through it a few times, but once again, Meta, Microsoft on Wednesday, Apple, Amazon on Thursday. Just to sit on Apple, I think a great case study for the broader economy at the moment. We're all grappling with this. We saw it in retail sales last week. What's the difference between genuine, sustainable underlying demand and just a front loading of purchases? And that will apply to Apple earnings later this week. We saw all the stories about people piling into the stores buying what? iPhones. Is this the elusive upgrade cycle we've been looking for, or is this just the front loading that we've seen elsewhere?
Lori Calvasina was our poster child earlier this morning when she said she bought an iPad to get ahead of her child running out of his at a time when prices were going up. It's a good question, and it really raises the issue of how much they're going to double down on the next model or the next great thing to try to generate that excitement. Everyone wants to know, what are you doing about China? How quickly can you move to India? What exactly is going to the hit going to be?
A big 4-day rally into these earnings. Apple up 8%, Microsoft up 9%, Meta up 13% in just 4 trading days. Equity futures this morning softer by just 0.1%. Up next, Neil Dutta of Renmac, Lotfi Karoui of Goldman Sachs on the risk of recession. The opening bow 60 minutes away. At the moment on track to snap a 4-day winner streak, but very marginal losses, softer going into the cash open by just 0.1% on both the S&P and on the Nasdaq. With a few hours to go, or rather 60 minutes to go until that cash open, let's get you some morning movers with Danny Berger for more. Hey, Danny.
Hey, John. It's going to be a busy earnings week, and ahead of that, we're getting a lot of sell-side action, the most recent of which coming from HSBC and Eli Lilly, giving it a double downgrade to sell, saying that the risk-reward for these shares simply aren't attractive anymore. Too much optimism is priced in, especially because there's economic sensitivity to the adoption curve of GLP-1s. Those shares down 1.2%. Also down over the weekend, we got a report from Wall Street Journal on Huawei building chips that look like they might be able to rival NVIDIA. Annmarie mentioned this with Angelina Zino. Those shares down 1.33%. Still early stages, more testing needs to be done, but again, challenging that narrative of American exceptionalism when it comes to tech and AI. Finally, we did get some earnings this morning. About 2 hours ago, we heard from Domino's Pizza. Those shares down 2.5%. Sure, their earnings for the most part held up. but that was just because of international sales. Their domestic same-store sales fell 0.5%. The expectation was for it to gain 0.33%. We heard from the CEO, all of them singing from the same hymn sheet, saying that macro uncertainty is weighing on consumers, John.
Danny, thank you. That stock is down by 2.5%. 3 movers to watch going into the cash open. Lots of data to look for through the week. Job openings, ADP, claims, ISM, payrolls on Friday. Mike McKee has it all. Morning, Mike.
Good morning, John. Might be a steel cage match this week between earnings and the economy. We haven't had a lot of economic news to trade on lately, but we do get it, as you mentioned, this week. Starting tomorrow, really, today you kind of get the day off, but we get trade, the first figures on trade for the month of March. Will it show any kind of impact from tariffs? Jolts, maybe not so important this time around. And consumer confidence, everybody's keeping an eye on that because of what Danny was just talking about, our consumers pulling back. Wednesday is what I'm calling acronym day. ADP, GDP, ECI, Employment Cost Index, and PCE, along with the personal spending and the personal income numbers. Thursday claims, of course, and then ISM manufacturing. There's going to be a lot of interest in what those people are seeing in terms of new orders. Are companies pulling back as well as consumers? And Friday, everybody's favorite, the jobs report, ISM Services, comes out after that. Won't have a big bearing on trading, but the jobs number certainly would. The good news this week is the Fed is in blackout period, so we are not seeing any Fed speak. You can take that part of the week off.
Mike McKee, thank you. Looking forward to that. Appreciate it. Thank you very much. And the lack of Fed speak as well, I think, is welcome, given how much we've had just recently. Neil Dutta of Renmac joins us now for more. Neil, welcome to the programme, sir. Before we get into details, Neil, you wrote about it recently. I just want to sit on this just for a beat. The rug pull that we've seen to consensus, Neil, that you've written about, just frame that historically, how quick, how vicious this has been.
Well, as you know, I think one of the ways recession works is through that element of surprise. So people think things are going to be okay, and then they're not. And that prompts the clearing out of inventories, investment, hiring, and so forth. And it's been quite dramatic. Remember, we went into the year looking for Q4 growth of around 2%. And now it's around 0.5%. So you've seen a fairly meaningful downward revision to GDP growth expectations for 2025. And if you go outside the COVID years, the last time anything like that's happened is 2009. So it's pretty dramatic.
You've been tracking some weaker data, not just at the start of this year, but from the back end of last year as well, Neil. Just give us the trend of things at the moment and how you'll navigate payrolls on Friday. Because I can tell you, for a lot of people in the market at the moment, they seem to be willing to ignore strength and they'll triple down on weakness. What's your approach?
Well, I think that makes sense because, to me, it's to the extent that any number is strong, it's probably somewhat backward looking. And if it's weaker, it just means that the economy was even softer than we thought going into all this. But, take a step back and think about what happened last year. We saw very strong growth in consumer spending that was driven primarily by, or to a large extent, by a decline in the savings rate. If you look at real incomes excluding transfers, it's up only 1.5%. So even if you assume the savings rate stable, you're going to get weaker consumption. At the same time, non-residential business fixed investment contracted towards the end of last year. It only added about 30 basis points on average to growth in 2024. Believe it or not, John, that's actually less than the contribution from healthcare services consumption. So it just tells you about the sort of cyclical momentum in the economy going into 2025. This year, I think what's been notable is the ongoing increase in completed unsold new housing inventory, which sort of begs the question about what home builders are going to do. It probably means they're going to cut back on residential construction. And I think in turn, that probably means some slowing in residential construction employment. So, I think the onus is really on the economic growth bulls. My sense is that, things can get a little bit sloppy over the next couple of quarters.
Let's say, Neil, every single Fed official is watching right now in their quiet period. They're taking advantage of that and reading all of your reports and saying, OK, we're going to cut by a full percentage point. We'll cut dramatically in the next couple of meetings in order to get ahead of this. How much would that help?
Well, I don't know that it would help that much because I do think to some extent the train has sort of left the station. That doesn't mean I wouldn't encourage them to start thinking about recalibrating monetary policy. But I think it's important to keep in mind that, think about the areas of the economy that are affected the most by the trade war. It's stuff like consumer durable goods. It's stuff like housing. So those are the areas that the Fed can help, but I don't think they can offset a full impact of the trade war. So the Fed is just one part of this, but really to kind of totally shift the narrative, I mean, you need to see, the uncertainty sort of abate.
I feel like we've switched roles, Neil. It sounds like you're really downbeat. And I'm thinking, well, the companies are not sounding that downbeat. Corporate executives are coming out and saying we can manage through that. And their estimates have actually surprised to the upside in a large number of instances. Why does that not come for you and give you a sense that actually maybe it's not as bad as people are saying?
Well, I mean, time will tell. I mean, I don't know that that's true. I just saw an article in the Wall Street Journal this morning talking about how companies are sort of shelving their CapEx plans. The fact that we're talking about a large amount of companies pulling their earnings guidance, Lisa, I mean, if they're pulling their earnings guidance, they're not spending. Point, simple as that. So, I don't really see that much optimism out there. If anything, CEO confidence has been waning because people got the sequencing wrong, right? I mean, when they bet on Donald Trump, they bet on tax cuts, deregulation, and tariffs in that order. And obviously, we started with the last thing first. And that's kind of the big issue, in my opinion.
Because as you know, Neil, the last thing is the thing that Trump can do unilaterally by himself. You recently had a piece out where you talked about Trump's recent comments around Powell, soothing comments around China. And you said that Trump is starting to, quote, feel the market. But at the end of the day, the tariffs are in place when it comes to China. How quickly, Neil, do you think that they need to start evaporating or this is going to get brutal very quickly?
Well, I think we're already there. I mean, there's a lot of interesting comments that the market sort of runs with on any given day. But at the end of the day, just look at what's going on. We effectively have a trade embargo in place with one of our largest trading partners. And the primary debate right now seems to be whether are they talking or not talking? Are they fake talking? Are they talking through back channels? I mean, it's a little bit ridiculous. Just focus on what's actually happening. We have an effective tariff rate in the 20s, and we continue to have fairly substantial tariffs on with China. That's effectively resulting in a zero in terms of bilateral trade. To me, that's important, and that's going to mean that inventories are going to be pretty problematic. Relatively soon, probably sometime over the next month.
Neil, final take. Kevin Walsh, how close are we to installing a shadow Fed chair?
Well, I mean, he has a habit of just, you talk about the blackout period. Mike McKee mentioned that. I find it hysterical that he's out in the Wall Street Journal with an op-ed. But, look, I took a quick read of his op-ed. I think it's ridiculous to really say that the Fed is the reason why we have profligate spending. I mean, remember when interest rates were zero and the Fed was doing open-ended QE, the government at the time was going out on an austerity budget, and we talked about sequester and all that. So I think he has the cause and effect wrong. I mean, the reason why rates were so low was because probably there was austerity, not the other way around. I think talking about firing Powell is bad. Replacing him with Kevin Walsh wouldn't be much better.
Neil Dutta of Renmac with a strong and powerful punchline at the end there. Neil, thank you, sir. Appreciate it. On Kevin Walsh in the Wall Street Journal.
Right. But he did talk about the fact that there is a terrible fiscal trajectory. But he said this: I struggle to absolve the Fed basically of the nation's reckless spending. Neil has been very consistent on Kevin Walsh. When his name was floated to become Treasury Secretary, then the whole idea was actually he'll save for the position of Fed chair. He's clearly on the short list. But Neil's point is this is someone who actually is hawkish when it comes to whether or not he wants to cut interest rates or raise them. That is something that does not jive well with President Trump.
Historically, that's certainly been the case. That's for sure. Lotfi Karoui there of Goldman Sachs joins us now for more. Lotfi, welcome to the programme, the head of credit strategy over at Goldman Sachs. Lotfi, I'm not going to ask you about that. Don't worry. We're going to talk about credit. Let's talk about where credit is at the moment. And I think the big question, what investors are willing to pay for US assets. Has there been a major reassessment or not?
Well, based on last week's price action, no. Actually, if I take high yield spreads as an example, we're back below 400 basis points, which is no matter where you stand in terms of where the effective tariff rate is going to go, this is not the adequate compensation that you should demand in the face of the current path of the macro environment here. So the answer is no, as far as spreads are concerned. Now, I think we've talked about this multiple times the last couple of years. In credit, there's two conversations. There's a spread conversation. There's a yield conversation. I'd be more constructive on the value proposition of credit from an all-in yield or total return standpoint. The math is actually quite simple. Take investment grade as an example. You're being paid a little less than 5.25%. I would consider that to be actually a pretty good value proposition. If tomorrow we have a recession, it's very likely that whatever widening you're going to have on the spread component will, to a very large extent, be absorbed by the base yield or the treasury yield component. So it depends how you see it.
So it matters what lens you're looking at this credit market through. Let's look at it through this lens. The economy is about to break down. The hard data is about to catch down to the soft data. What does it mean for you then?
Spreads should go wider. Look, we are, I'll take high yield as an example again, 400 basis points. You're probably below the first quartile of the last 25, 35 years. If you see that catch down where the hard data actually, catches down with the soft data, then we think spreads should, at the very least, go back to levels that are more in line with historical medians. And by the way, we touched those levels about a week and a half ago, and we were there already. So you should, I think, the path of least resistance should be for some rebuild the premium.
Is that not going to happen outside of the U.S.? Is that almost the haven right now, given that there is less volatility, at least from a policy perspective, generating from the likes of Europe?
Yeah, I mean, look, that's definitely a big debate we've been having with investors. I will tell you, a lot of folks actually push back on that idea, and a lot of people have in mind sort of the playbook of 2018, which, by the way, pales in comparison relative to what we have today. But a lot of people think, look at that episode and say, oh, actually, back then, U.S. assets did better. So, you look at the Dutta market in credit, it outperformed the euro market. I would take the other side of that argument today. I do agree with you. I think the U.S. feels like the epicenter of the shock today. By the way, if you look at relative performance of U.S. stocks or U.S. credit versus Europe, the outperformance of Europe has been largely preserved after April 2nd. I don't think it's reasonable to expect Europe to tighten while the U.S. is going wider. I mean, that would be highly unusual. But I think in relative terms, you should expect the euro market to outperform sort of its beta relationship.
Just to build on that, there was a theme for a long time, a mantra, don't fight the Fed. Everyone said, don't fight the Fed. Now, the Fed isn't in a position to be cutting as aggressively as, say, the ECB, the Bank of England, the Bank of Canada, the Swiss National Bank. At what point don't fight everyone else but the Fed because they're going to be cutting more aggressively?
I mean, that is precisely one of the reasons why I prefer the euro market relative to the U.S. market, because the ability of the ECB to step in and provide easing is just stronger than the Fed. I mean, this is not 2018 where the Fed, or early 19 where the Fed was in a comfortable position to deliver those insurance cuts. The reality is this is a stagflationary shock. It just constrains, I think, the Fed in terms of its inflation mandate, and it constrains monetary policy. Those constraints are a lot weaker in the rest of the world, particularly in Europe right now. And so that would be another reason, actually, to look at markets outside of the U.S. in terms of benefits of diversification.
Inside the U.S., is that a bigger risk for the sovereign or the credit?
I'm not in a camp that thinks this is a problem for the sovereigns. And so if you ask me, basically, where will Treasury yields go in the event that we have a negative growth shock, I would say lower. The path that gets you there might be a little bumpier than usual, and the long end of the curve might be a little bit more volatile for a variety of reasons. But I do think that Treasury yields will deliver that hedge that you expect in a bad state of the world.
This, as you know, is a really important conversation and a debate happening on investor committees all around the world right now. What will Treasuries do in that economic downturn? Do you see, and we asked this question in the previous hour, I'd love your take on it, do you see investors treating corporate credit and the sovereign debt as the same thing in one bucket, or are they discriminating between the two, at least over the last month?
Not yet. Not that I know, basically. But I think, people are, even for AA or AAA credits, which granted are trading with a spread of maybe 15, 20 basis points, I think most people are still drawing a very clear distinction between the sovereign curve and the credit curve.
Well, we were just talking about that with Amanda Lynam. How much of a crowding out will there essentially be with the U.S. government issuing so much debt in an increasing amount? They're going to be announcing some of the estimates for the current quarter today and then giving more details on Wednesday. How much does that matter to you?
I think it matters as far as swap spreads, for example, go. So the relationship between swap rates and treasury yields, I think, yes, supply drives that a lot. On the credit side, I would actually say we started the year quite bullish, for the lack of a better word, on supply. We were expecting $1.75 trillion, but you're not seeing any M&A. You're seeing actually very little M&A. And so that acts as a self-stabilizing mechanism in credit. And I would say from a net supply standpoint, which I think is what matters eventually, it matters more than gross supply, things have actually been quite benign in credit. I mean, certainly in high yield, net supply is barely positive. In IG, it's always positive, but it's much less positive than most people had expected going into the year. So I would get concerned if we see both markets kind of pushing in the same direction, where you have more supply on the treasury side, more supply on the credit side. Honestly, we're not seeing any of that now.
Lotfi, well framed as always. Good to see you. A clinic on corporate credit with Lotfi Karoui there of Goldman Sachs. As Lotfi speaks, equity futures turn positive, just about on the S&P 500, turning negative throughout the whole of this morning's session and just turning positive for the first time on the S&P. With an update on stories elsewhere this morning, with your Bloomberg Brief, here's Yahara Hackers with more. Hey, Yahara.
Hi, John. Spain's grid operator is holding a press conference to address the major blackout that started about 2.5 hours ago. The blackout impacted power and phone lines, with public transport, traffic lights and phone services mostly down in parts of Madrid, Barcelona, and even in Lisbon over in Portugal, while trains were also mostly halted. Meanwhile, a suspect has been charged with murder in the Vancouver festival attack. Police say 30-year-old Kai G. Adam Lowe rammed his car into a crowd on Saturday night, killing 11 and wounding dozens. Police said they're confident the incident wasn't an act of terrorism and that the suspect had a history of mental illness. And IBM announcing just now it will invest $150 billion in America over the next 5 years. The company saying it's part of an effort to, quote, fuel the economy and to accelerate its role as the global leader in computing. The investment includes $30 billion for research and development of IBM's U.S.-based production of mainframe and quantum computers. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, I know I say this every single week, but this week, seriously, absolutely packed with earnings and economic data. We'll bring you a preview up next from New York. You're watching Bloomberg TV. Quite possibly my favourite week of the quarter, when you get those earnings from the big tech names. Plus, you get a payrolls report as well. Equity futures going into this week just about positive into the opening bout. The opening bout 38 minutes away. Earnings, data, and lots of commentary from this administration coming right up. This quite literally is the busiest week I've read in a long time. Today, executive orders at 5 p.m. Eastern Time, plus Canadian elections tomorrow. President Trump holding a rally in Michigan, plus JOLTS data and consumer confidence Wednesday. PCE data plus earnings from Meta and Microsoft Thursday. Another round of jobless claims and results from Amazon and Apple. And finally, on Friday, April payrolls to round out the week going into the weekend. Plus, you'll get a lot of news conferences coming from this administration for the first 100 days of Trump's second term in the White House. Happening right now, the White House press secretary, Caroline Leavitt, holding a news conference alongside the border czar, Tom Homan. Joining us now, Bloomberg's Tyler Kendall from outside the White House. Tyler, let's get to it. How many news conferences are we going to get this week?
Yeah, hey, John. Well, we're expecting a lot, and most of them are going to be early, including tomorrow. We're going to expect that Treasury Secretary Scott Bessent will be there with Caroline Leavitt at 8:30 a.m. Eastern. I have to say, I'm here a lot of early mornings, and this is by far the busiest that I have seen the White House before 9 a.m. It's clear that this administration is trying to kick off the day here with some headlines, particularly as we see recent polling over the weekend showing that voters are issuing that concern, particularly when it comes to President Trump's economic policies. Perhaps that's why we're seeing some more coverage on the immigration policies, a polling area where President Trump is doing relatively well. Now, of course, we're going to be be watching ahead of tomorrow. Treasury Secretary Scott Bessent, I will say that he came and spoke to us reporters earlier today. He said that there will be a tax meeting, something that we've been covering all morning, because this administration is really putting up the pressure, ramping up on lawmakers as they come back to Washington today to try to get done that reconciliation package that this White House really is banking on to fulfill the rest of its economic agenda when it comes to tax cuts.
So it sounds like the Treasury Secretary will be hosting the Big Six. Then you have the Speaker going over to the White House with a meeting with President Trump. Tyler, this timeline, getting it done Memorial Day, outline to us why this is so difficult.
Well, it's considered to be incredibly ambitious because we have to keep in mind this is being done through the reconciliation process. That means that there's very little room for error here when it comes to Republicans because they can't afford to lose any votes because they're not going to have the help of Democrats to get this through. Now, our reporting indicates that we could likely see a different sort of date pushing Congress forward, and that would be a revised X date from the Treasury Department once they get in more of those tax receipts to show when the U.S. is expected to ultimately default on its payments. And that could potentially be really the deadline that is pushing lawmakers here. Because one thing is for certain, this White House wants to see this done as quickly as possible. But whether or not they can agree on tax cuts, but also keep in mind the spending cuts that are going to be included in this bill, which is very, very politically fraught at the moment, particularly when it comes to potential cuts to Medicaid, just really remains to be seen. But both chambers are going to have to agree here with some pretty difficult conference members that have to agree to.
Tyler, appreciate the breakdown. More from Tyler Kendall throughout today on Bloomberg TV and on Bloomberg Radio. Bramo, what a week. Earnings and data. If you could pick one right now, what would you take?
Absolutely earnings, because right now we're looking at the forward look and potentially how companies are spinning this forward. You said that this is the busiest week in a while. The busiest week with stuff we can sink our teeth into and get some concrete information. And that's the key. Can some of the other stuff overwhelm some of that granular data that we keep getting throughout the week?
Do you know what I'd take? The president's drafts on his Truth Social account. That's what I'd take.
You think that they have drafts?
I still believe that the fate of this market and this economy is in the hands of one man and the social media account and whatever comes out of these talks.
Absolutely. When it comes to trade, what comes out of these talks is very important, whether or not he's actually having this conversation with Xi Jinping or it's, just negotiating tactic. The tax policy is going to be interesting. Scott Bessent telling reporters like Tyler, they're all going to be in there. No tax on tip, overtime, etc.
Equities turning positive. Looking forward to navigating this week with you. Coming up tomorrow, Brian Nick of New Edge Wealth, Savita Subramanian of Bank of America, Kathy Jones of Charles Schwab, and Kathy Boschanczyk of Nationwide. Live from New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Mutua Madrid Open update for Bloomberg TV and Radio from Tennis Channel. Mayuka Ichiyama clinched her first top 25 win as she took out third seed and recent champion in Charleston, Jessica Pegula, in straight sets. The victory also marked the first time the 23-year-old has won 3 consecutive matches on the WTA Tour. And don't forget, you can watch all the action live, daily, on Tennis Channel.